I welcome to this CPE session. I invite Mr. C.A. Mohan Ravi on the dais. Let's raise up for the ICA invocation song.
यैष सुप्तेषु जाग्रति यैष सुप्तेषु जाग्रति कामं 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 कामुषो पुरुषो निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्वैता
Thank you. For today's session, we have a list of elite panel. To begin with, I would like to introduce Sri C.A. Mohan R Lavi. Mohan R Lavi is a qualified chartered accountant in 1989. He has over 27 years of experience in industry across variety of industries, having worked in senior positions in finance, in manufacturing and software companies. C.A. Mohan has over 8 years of experience in practice. At present, he is a partner with the MS KP Rao and Company, Chartered Accountants, Bangalore, and heads the financial reporting practice of the firm. C.A. Mohan is the author of books on IFRS, Ind AS, KE, Audit Matters, and Sarbanes-Oxley's Act. His articles appear frequently in the Hindu Business Line, Deccan Herald, and the Bombay Chartered Accountant Journals. He is also a regular speaker at various forums and on financial reporting. With this introduction, I hand over to you, sir. Thank you. I would like to invite C.A. Ramanathan to present a small memento to C.A. Mohan.
So good morning, and I should thank SIRC for calling me to speak on this one-day program on financial reporting. Normally financial reporting enna nariya per varamatanga, so I think it's a little bit better than auditing standard at least. So it's nice that all of you have gathered here today. My topic is two topics basically. I'll be doing today's session and the evening session on FRRB reports. If possible, I'll request all of you to stay for that session more than the morning session. Also, very great pleasure to share or to speak along with a very good friend of mine from Chennai, C.A. Venkata Subramani. I would like to introduce him before he is formally introduced by the Institute. Sir has been authority on financial instruments. So when they asked me for this topic, the first thing I thought was demystifying financial instruments, and I think there is no better person than Venkat sir to actually talk on this topic. So he'll be taking it from 11 to 1 on that topic. My 1 hour is going to be very simple. Ind AS, the past, present and future. Nothing to talk about the past, something to talk about the present, and very little to talk about the future. So that is what we have got as far as Ind AS is concerned. India has moved to Ind AS from 2015, as all of you are aware. And I should say the implementation has been pretty smooth. We've not had too much of what you can say problems, so to speak, because India has always been following the international accounting standards. The international accounting standards became Ind AS, so India sort of had to fall in place. They did not go by US GAAP or any other sort of accounting standards. But I've put in here they moved to 2015 except, and I think this is a very big exception, banks and insurance companies, even as we are speaking today, are not on the Ind AS platform, which is a bit surprising because NBFCs are already on the Ind AS platform. NBFCs are already doing Ind AS, and they're doing the full blast Ind AS. There's no exception. There's no carve-outs specifically. They're doing the full blast Ind AS. So why banks are not doing Ind AS remains, I won't say a mystery, because in 2015, the Reserve Bank of India formed a committee to give a roadmap for Ind AS implementation and to find out what could be the possible challenges in Ind AS implementation. The committee report came out in 2015 itself. I don't think I need to tell you all what will be the impact if banks move to Ind AS. All of you must be doing, many of you must be doing bank audits. What do you think would be the most important areas or impact, which will impact banks when they implement Ind AS? Provisioning, very good. Leases also, okay, leases also, but provisioning is definitely there. Valuation of receivables, okay. Two main areas in the bank. One is, of course, what we popularly call as non-performing assets or provisioning, as you rightly said. The second would be your treasury income or treasury investments, which may have to be fair valued as per Ind AS. We don't know what will be the impact of the bank. RBI has been trying to slowly tell the banks that please try to give what is the ECL model. You try to work out some ECL model. And they have recently come out and said at least you will know what is the impact if you give us some sort of a ECL model. So these two areas are definitely going to impact the banks. But then we can't wait for long also. As I said, all of you must be doing bank audits. You very well know what happens in provisioning. How is provisioning made today? We have an IRAC model given by the RBI. We've got an IRAC model, we've got these prudential norms given by the RBI. Those prudential norms normally depend upon how old the asset is. The general tendency is the older the asset, the more you may have to provide for it. That is a general thing which all of us know very well. Ind AS goes a little bit ahead, as Venkat sir will probably talk when he speaks about this thing. It goes by what is called as a expected credit loss model, wherein you will have to provide for these bad debts earlier and probably higher amount also. Probably higher amount also. I always give this example. You take, for example, a standard like fixed assets. Who is the best person to decide what is the useful life of an asset? Don't worry about Ind AS or AS. Generally you tell me. Sir, the company. Idhe logic use pannunga. Who is the best person to decide how much to provide for a loan? The person who was given the loan. The bank. The Reserve Bank of India norms can probably be indicators. That's all. They can probably be indicators. That is why for NBFCs what RBI is saying is that you use, in fact even this committee report said the same thing, you follow the prudential norms. But if you want to provide more, please remember this. If you want to provide more, use the ECL model. Our battle with the manager during the bank audit is only this, no? To provide more. That battle happens in every bank audit, right? There they are saying, if required, you use the ECL model. Very interesting thing has happened as far as banks is concerned. 2015, the International Accounting Standards Board, they were on a global tour to promote IFRS. Global tour means what? Go to all the countries and tell them that this is IFRS, very good accounting standards, please follow them. They came to India also because they felt India is already following IAS, so what's the difficulty in going to IFRS? And in fact, this happened much earlier, not 2015, but 2009, 2010 itself. The MCA looked at all the standards and said that everything is fine. One standard we've got a problem. This is called IAS 41 Agriculture. They're saying, how do you expect us to implement an accounting standard, that to international accounting standard for agriculture in India? So MCA was not very convinced. They said, you give me a carve out for agriculture, we will implement IFRS or Ind AS, whatever it is called. But IAS we said nothing doing. If you implement completely. So we did not do it in 2009. But please remember, global tour. Global tour means they should go to all the countries. From Delhi, where did they go next?
United States.
Sir, United States. Delhi and the Robotono, sir. Ah, very good. Your choice, west or east? Neighbor. They went to Pakistan. The good thing about Pakistan is they don't have MCA, they don't have NAFRA and all. There were some 3 people sitting there in Pakistan. So these people went, IFRS went and said that, IASB went and said that, we are promoting IFRS, can you implement IFRS? India at least asked for standards. Pakistan asked a very simple question, from where are you coming? They said we are coming from India. Next question, did India implement IFRS? They said no, they are having some problems with agriculture. Then we will implement this. 2015, you will not believe this, 2010-11, State Bank of Pakistan was the first bank in Southeast Asia to implement complete IFRS, including IFRS 9, the transition time, IAS 39 and IAS, they did IAS 39, then IFRS 9. So one way we have helped them is to at least implement IFRS. But I believe that what is probably going to happen is that maybe in 2025, maybe 2026, banks and insurance companies will move simultaneously to Ind AS. This is what I would believe is going to happen, because insurance contracts today are more financial instruments than insurance contracts. So there's a combination of financial instruments and insurance contracts there. So I would believe that they are probably waiting for IRDA to come out with their guidelines. Even IRDA had come out with a roadmap, but again, that also was postponed because of various reasons here. But very interestingly, and this is something which will probably affect many of us who are in practice, who are probably having non-Ind AS clients. The question is, what happens to companies who are having a net worth below 250 crores, who will probably never go to Ind AS? The roadmap says only about 250 crores are listed companies or banks and NBFCs. The threshold is net worth of more than 250 crores. Once you cross it, you always have to be in Ind AS.
They will never cross. They will operate in such a way they will never cross 250 crores.
249 crores, so they will limit it. Completely agreed, sir. What happens to these companies becomes an interesting question. Here what the institute is planning to do, I would say, is that they want to revise the existing AS to bring it somewhere near Ind AS. May not be completely, Ind AS, but somewhat near Ind AS at least. In fact, if you look at AS 10 and AS 29 and all, they're almost like Ind AS only. Not much of a change as far as the revised AS 10 and AS 29, almost as per Ind AS only. They've also brought out a very interesting standard, simplifying the financial instrument standard also. They brought an exposure draft, but somehow I think it has not been completed, the project has not been completed. So you can expect that these below 250 crores clients, who will probably be a good portion of our clients, once the revised AS is notified, issued, maybe sometime in the future, you would find that that would become a good opportunity for us to also transition those clients to what is called as AS revised. It will probably be called as AS revised. I don't know what it is going to be called. Because nowadays we have to be very careful with what these standards are called. Auditing standards are going to be called Ind SA now. We got Ind AS, now we got Ind SA after NFRA notifies those auditing standards. So this is as far as the present is concerned. 117, in their enthusiasm, the MCA notified the standard, which is exactly as per IFRS, the IFRS 17 standard. But because they had to, the insurance companies had to implement IFRS completely, not necessarily only on the basis of IFRS 17, but also other standards. There was a deferral made. We do not know when it is going to come. Probably it will come at some point of time. And as I told you all, Venkata sir will speak a bit more about that. RBI is forcing the banks to sort of implement this ECL model in some manner. See, the idea is very simple. When you transition to Ind AS, the impact should be minimal. The impact on your P&L account should be probably to a certain extent equity also, should probably be minimal. That is why they are trying to tell the banks that try to provide a little bit more now, use the ACL model, see how it works out, and then you can probably transition at some point of time. So, since you have got the option of providing more in the ECL model, this has officially not been notified, but banks will probably move there. And that again will have to be done, as I told you, by the bank only. That is the past. Looking at the future. You look at IFRS, look at IASB. They are continuously on programs to improve their existing accounting standards, whatever they've issued. In the London office of IASB, we've got a group of people whose only job is to look at existing standards and try to modify it, change it. Suppose I give you all that job, what will you all do? Suppose I tell you all, your only job is to look at existing accounting standards, wherever possible, wherever you feel that there is feedback, or wherever you feel it's difficult, or wherever you feel that change is required, please give suggestions for modification. What will you all do? Simplify. Okay, simplify is one good word. What else will you all do? Vikram. You will look at existing, please remember, this is your job. You look at existing standards, and sir said simplify. You will want to do some changes to the standard, because that's your job. You have to suggest it. In India, we have got used to Schedule 3 of Companies Act. Ind AS Schedule 3 also we have got used to. Would you want a change in that? Well, we got used to it. So, Excel previous year figure current year. Would you want to change that? Or would you want the existing Schedule 3 continue? Are you comfortable with Schedule 3? These people feel that no. This presentation is okay, but we'll change the presentation. We'll give recommendations for changing the presentation. And this is going to be a very major change for all of us. That's why I'm trying to spend a little bit of time on that. So let me ask you all a question. Cash flow statement. What is the importance of the cash flow statement?
Movement of cash.
Very good. Movement of cash. From the company point of view, what is the criticality of a cash flow statement?
How the funds are being utilized.
Very good, sir. Analysis, how the funds have been utilized. So, we have no doubts about that. But for most of the people, especially the people in the company, the main purpose of cash flows, it has to tally. Correct? There is one magic word in cash flow called as changes in working capital. One magic line is there. What is in that, nobody knows. It will be there. Previous debtors, inventories, changes, all that will be there. But when the difference in cash flow arises, invariably it will go to changes in working capital only. But if you look at how people have actually analyzed cash flow statements, as he said rightly, people are analyzing the cash flow. there is a thumb rule which many people nowadays are using, and the thumb rule is that the total of operating cash flows for a company which is supposedly a good company, total of operating cash flows should approximately equal total of financing and investing cash flows. Should not tally, please don't make it tally. But at a very broad level, total of operating cash flow should be approximately on an average, because if you invest, you will result in an operating cash flow. If you take a finance, it will result in investing cash flow. The very basic thumb rule. People in IASB got hold onto this. They said, okay, people are only tallying the cash flow. People are not analyzing the cash flow. So what we'll do now? We will change the balance sheet itself. We will change the P&L account itself. We will make the P&L account almost equal to a cash flow P&L. It may not be receipt and payment, may not be so bad as that, but probably we are getting there. At some point of time, we will probably get there. So you will see now that, and please remember, this is going to be when this IFRS 18 comes, Ind AS 118 comes, all of us will have enough and more work to do in terms of changing this to Ind AS or whatever it may be called, right? Okay, what is the requirement here? The subtotals are required, disclosures about management performance measures are required, and something else is required for this thing here. I'm just going to talk to you about this particular thing here. They are going to talk about a separate line item called as operating profit. There's going to be a separate subtotal for what is called as operating profit, which you can apparently link with your operating cash flows also. There is going to be profit before financing and income tax, and subtotals are required for these particular items here. So your P&L account in effect is going to become like, you can see here, they're talking about operating cash flows here. They're talking about investing, sorry, not cash flows, operating expenses, investing expenses, and financing expenses. So if Ind AS 118 is implemented, your P&L account will be a mirror image of your cash flow statement. It will become a mirror image of your cash flow statement, and you will be able to probably link these two also. Yes, sir.
Be there or not?
Accruals will be there. And this is something which is again extremely important for people who are trying to analyze the financial statements and all those things. Many of you would have probably seen or read Warren Buffett's annual newsletter to the shareholders. He talks about a lot of things, how Berkshire Hathaway has done, how is the performance as compared to the stock market, a lot of things. But he does one more very interesting thing there. Warren Buffett has somehow not completely aligned himself with US GAAP. He says US GAAP has a lot of gaps. So what he does is that he gives his own adjusted profit to the shareholders. He tells them that, okay, auditors have certified some profit, that is fine, that is as per accounting standards, US GAAP, whatever it is. But if you really want to analyze Berkshire Hathaway as a company, look at my profits. I'll adjust my profits because I don't agree with many of the requirements of the accounting standards. If you want to analyze Berkshire Hathaway as a company, don't take the auditor's financial statements, you use my measures. And one of his, or rather, few of his points has been, say, for example, on impairment, he says. On impairment, he says, I need not necessarily follow what the accounting standard says. I can always do a reversal of impairment. Some restrictions are there in US GAAP on reversal of impairment. So his point is that if you are forcing me to downgrade, that sort of a analysis. Hand mic கொடுத்துருங்க. Hand mic. Yeah. So he does that sort of analysis. So he'll say, I don't agree with, for example, financial instruments, derivative accounting, mark-to-market accounting. This is my own analysis of that. Now, many of us would have probably seen something called as management discussion and analysis in the annual report. It is called as MD and A statement. This MD and A statement, what people do is that the management gives an assessment of whatever, profit and all those things. IASB had previously had a project in which they said that if you are giving those figures, that also should be as per IFRS only. But management said no, we will not do that, we will do our own thing. You have anyhow balance sheet, you have got P&L account, you have got notes and accounts, do whatever you want there. MDA is my section, I will continue what I am doing. I will not change that. So now what they have done now in this revised IFRS 18, Ind AS 118, whenever it comes, they have said okay, you do what you want, doesn't matter, but give a reconciliation. You give a reconciliation, how you have adjusted what is called as non-GAAP profits, how you have adjusted non-GAAP profits to whatever has been the reported profits here. And they are given what is called as management performance measures here. You will have adjusted operating profit, adjusted EBITDA, adjusted all these things. So if you are the shareholder of a company, you will know which side to take, whether to take the side of management. So you will basically be looking two operating profits, two EBITDAs, two performance measures, so to speak here. So they have said that you now give us a reconciliation. This is a new thing which has not previously thought of by the IASB. This is again coming newly now. It will probably come into the the Ind AS 118 also. In the Indian context, not many companies do so much of what you can say non-GAAP adjustments, but the fact remains that standard is saying that if you are doing it, you please give a reconciliation so that the shareholder knows exactly what metric you are going to use for the purpose of analyzing your financial statements here. So in US GAAP, okay, so in US GAAP, there are some restrictions on reversal of impairment losses. There are some, because see, impairment FD&I is only based on your cash flow, right? So
impairment losses, components of impairment losses, any
investments, sir. Invariably, Berkshire Hathaway is an investment company, sir. Mostly investment company only. All subsidiary companies know those things. So when you have provided for an impairment in the past, that improvement has, that company has improved, or that investment has improved, or your cash flow estimates. Your cash flows have changed, whatever it may be. There are some restrictions in US, there are some restrictions in US GAAP on reversing it. So what Warren Buffett is saying is that I will reverse it. Because this company has improved. I know what the company is doing. I am reversing those impairment losses, and therefore my profits have increased to this extent, or whatever that the financial condition is. But also if you look at it from the point of view of, say for example, provisioning, that's one topic which comes to us very, very frequently. Provisioning. What do we do for a provisioning? I may be bound by this Ind AS 37 or AS 29 to provide for a certain amount, because please remember the standard uses the word called as reliable estimate. It used the word called as reliable estimate. Rendume kashtam. Reliable kashtam, estimate kashtam. But because of various factors, I may not, or I may be prevented from reversing that estimate or that provision in the past, which I have made in the past. I'll give you an example. Ellarkum theriyum, the Vodafone case, all must have heard of it, right? The income tax case. They gave it to one of the best Supreme Court advocates. The first question which Vodafone asked the advocate was, what will be your fees? He said, if I go and approach the Supreme Court, 25 lakhs per day. Forget hearing and all. Just going to the Supreme Court, 25 lakhs per day. Next question Vodafone asked was, okay, how many hearings do you expect this will take? He said, about 10 hearings. Etana provide panno? Very good, 2.5 crores. They provided for it, 2.5 crores. Reliable estimate. What is reliable? Advocate. Estimate is Supreme Court. Both are advocate only. But Supreme Court got some information about this thing. In 3 hearings they said that this is not a maintainable petition at all. Single bench. Single bench dismissed it saying this is not a petition which can be maintained. Because there was some issue with, some issues came up there. There was one company called as ACG which was used. Everybody started asking what is ACG. You're talking about Vodafone, you're talking about HSL, SR, how does a company called ACG? Main shareholder who sold was a company called as ACG. After some digging they found out that ACG is equal to avoid capital gains. Actually email correspondence, all that happened there. But now they have already provided for 2.5 crores. In 3 sittings, Supreme Court said that not a maintainable proposition. Can you have to reverse it? Will the auditors agree? They should agree, right? They should agree. But they agree not is a different issue altogether. But the income tax department said we'll refer to a larger bench. We don't want to, single bench we don't want, we'll refer to a larger. Actually that's what happened. The income tax department referred it to a larger bench. Now what happens to your provisioning? Either you again provide or don't reverse it. One of the two things. Either don't provide or reverse it. Don't reverse it. One of the 2 things. So like that, in your financial statements, whatever estimates, I won't use only estimates, anything which you feel you have used for the purpose of adjustment. Say for example, I'll give you again the example of fixed assets only. I told you all, useful life, who is the best person to decide? Management. But you got a schedule in the Companies Act. We would prefer to go by the schedule for the purpose of auditing or whatever it may be. They'll say, why it's already there, no? Why do you want to change it? You may want to revise your useful life also in your MPM. You may want to give a different useful life because you feel that this asset is not going to be used so frequently. So that reconciliation becomes extremely important. More than the reconciliation, it is also a question of explanation why you are using this. You look at all these e-commerce companies. Whatever you name it, Flipkart, Amazon, you name these companies. Can we expect EBITDA to be a measure there? Can we expect profit after tax to be a measure there? They will present us per Ind AS a profit and loss account and a balance sheet. They will have invariably a loss. I can't use it as a measure. If you go to what they are talking about, they'll talk about gross merchandise value, average number of orders per day, all those things they'll talk about. So it's a completely non-financial metric. So what they are saying here is that if you want to use those metrics for analysis and they have a link with the financials, you please give us a reconciliation what you have used so that we are able to understand what is going to be done there. This is how a typical reconciliation would look like. This is just an example given by the IASB, so I don't know the individual components here, but they have just said that you can use all these things for the purpose of giving a reconciliation and saying that this is going to be my typical reconciliation, what you call as MPM, management performance measures here. Again, here as I said, in the Indian context, I would probably think that these adjustments would probably come only for some things like provisioning or some estimates which you are not able to reverse because of either regulatory requirements, auditor requirements, all those things. So maybe you can probably use that as a performance measure and try to give a reconciliation. That's what I think we would probably, this thing here, right? Okay. The other thing which this IFRS 18 has also done, and which I think Ind AS and AS would also do, is that, in fact, the reason why it is called as International Financial Reporting Standards is because the focus is not on accounting. The focus is on reporting. Reporting means invariably disclosures. Invariably disclosures only. If you look at your Ind AS financial statements today, and especially financial instruments, which Venkata will talk a little bit about, if you read the disclosures on the Ind AS financial statements, see, aggregation is balance sheet and P&L account. Disaggregation is notes and accounts. Disaggregation is notes and accounts. Aggregation, disaggregation, that's what they talk about. The idea is that in case the shareholder, analyst, whoever it may be, wants to understand a particular piece of information from the financial statements, sir, it will be there. It will be there. It will definitely be there. You will have to find it out. What you want to see, you will have to find out. But we all know this as a fact. Annual report today, average length of annual report is about 400 pages. Average length. I am saying average only. Sometimes even 600 pages. Who is going to read all the 600 pages? Correct means you will read, huh? Interestingly, this is a very interesting fact. Every person will look at the annual report with what he wants to see there only. You are a shareholder, you will see profit. Okay, cash flow. Cash flow. Very good, very good. Please look at the cash flow. Analyst will probably look at some other more in detail. Very interesting situation happened about 5, 6 years, 7, 8 years back. Friend of mine who was in Germany, German person, had written a book called as Impact of IFRS on Industry, which was published by Wiley in London. I looked at various industries, what is the impact. Somehow he bought that book. And he said that, now that you have written a book, you know so much about IFRS, I've got a question to ask you. I said, okay, please ask. I've got equity shares in Deutsche Bank. I'll send you the annual report of Deutsche Bank. You analyze the annual report and tell me whether I should keep the shares or sell the shares. I said, okay, you can't say no to a friend. He sent me the annual report, 2016, 600 pages. PDF format, 600 pages. What do you do? Why, sir? Please sell immediately. But I went one step ahead. I asked him, okay, how many shares do you have got? I've got 10 shares. So when he said 10 shares, typical Indian chartered accountant mind, sell 5, keep 5. Why take a risk? I thought I will tell him that. But then I thought, okay, maybe he'll feel bad and also a friend. Something else. But I actually took the trouble of reading the entire annual report. Okay, few pages I skipped, but I read the annual report. And trust me, after reading the annual report, I was more confused than I was in the beginning. Unable to take a decision. Deutsche Bank says they will sell their bank, they can sell their banking business. If they sell their banking, one of the risks they mentioned was they will sell their banking. If they sell their bank, what else is left there? So at the end of almost 2 months, I told them that I'm really sorry. Based on the annual report, I cannot give you a decision. I can't give you a decision because there's so much of information there. Such an information overload is there. I'll not be able to give you a decision. He said, no problem, thank you, I've already taken my decision. I kept 5 shares and sold 5 shares. which I thought maybe I should have probably told him, even before or maybe a few days out. But then, on the lighter side, on a more serious note, these disclosures are becoming so detailed that the purpose behind this is very clear. Accounting will all do, there's no doubt about it. There's no two ways because auditors are there, whatever, right? But from the company point of view, if you are taking a stance which you feel needs to be conveyed to the shareholders, you will have to probably give that in the disclosure and also give a necessary explanation. Now what has happened in 118, IFRS 18, you will have to give this reconciliation, also have to give an explanation what you are using as a metric. So that becomes a very useful piece of information. Okay. Aggregation, all that is this. Employee benefits, specified impairments, all this is there. I've just given this thing, Statement of cash flows, there are only some limited changes because your P&L account itself has become a cash flow now. There are only small changes to the statement of cash flows, but this also would undergo a change. I think from the Indian context, what we need to be very, very clear and careful about is that the Schedule 3 will probably change. Your Schedule 3 will probably change as per Ind AS 118. And when the Schedule 3 changes, we know what is going to happen. What will happen when Schedule 3 changes? Obviously, there will be a lot of changes in other reporting requirements also. As we are speaking today, there is no exposure draft of 118 which the Institute has brought out. This is actually applicable only from 1st January 2027 abroad. So normally we can expect 31st March 2027 for it to be announced in the Indian context. MCA has got this very interesting habit of announcing standards in the last week of March. 25th to 31st is their active time. 25th to 31st they'll say that Ind AS 118 has been issued, official gazette notification, please implement immediately. But it is not a question of only announcing the accounting standard, it is also a question of revising the schedule. So I would believe that because both are involved, they would give us at least a 1 year time gap to transition to both the standard and also to implement the revised schedule, because there's no point in revising the standard without change, because this is presentation of financial statements. They have to probably do it for all this, the division 2, they have to probably revise the entire division 2 itself. And we should also not forget the fact that there will also be a change in the notes and accounts, whatever we have to disclose in the notes and accounts here. Okay. So this is basically what the future is going to look like. We will have Ind AS 118, which will probably come in from 27 March. If they've also brought out something called as IFRS 19. This is only a disclosure requirement for subsidies without public accountability. But I'm going to leave you all, before I hand it over to Venkat sir, with a very interesting question. IASB, as I told you all, have got a number of projects. Number of projects are there. They're going to change the standard on business combinations, IFRS for SMEs. They're going to make some changes there. Lot of discussion points. And I was able to observe yesterday a very interesting discussion point on Ind AS 115, and the discussion point is about revenue recognition only for tuition fees. Revenue recognition only for tuition fees. I'm going to leave this with you all as a thought to just to give you all an idea as to how deep the IASB is going in terms of trying to change the accounting standards. The problem before the IASB is very simple. There is a 12-month schedule for, let us say, a school or education institutions to collect the fees. 12 months there's an activity, there's a monthly fees which is payable. It also have they also have an option of annual fees. Because less than 1 year there's no need for discounting and all. The problem before the IASB became that 10 months active classes are there. 10 months active classes are there. 2 months the teachers, they actually, there are no classes, but they do other admin activities, like they do, correction of marks card probably, setting syllabus for the next year. They do all those activities, basically admin activities. So 12 months fees collected, 10 months students come, 2 months admin activities. You all will ask, what is the problem here? The problem here was IASB is trying to decide, should revenue be recognized over 10 months or 12 months? This is their discussion point. What will be your solution for this? Don't say 11 months, please. 10 months, 12 months. Why, sir? 12 months? Oh, they're collecting the fees for 12 months. Activity is confined only for 10 months. He is saying they are operating only for 10 months, so do it only for 10 months. IASB has got a very interesting point of view. They are saying allocate one portion of this to admin activities also. So if you are collecting 5,000 rupees per month, 5,000 into 10 will become 50,000 rupees. That's actually very, on a EMI basis or a straight line basis, it becomes very simple. They are saying don't do that. How much of time is being spent for admin activities? You give one number to that. That revenue recognized only in month 11 and month 12. Salary will be paid. Actual working only 2 months. But sir, I can respond to it immediately. I think after Ind AS has come, matching concept will have to unmatch, I think. Because really, matching concept is not there in Ind AS in many things. But then, the reason why I gave this example to you all was because one person asked IASB, why are you splitting your hair on such a point here? 10 months, 12 months, what difference does it make?
We pay the 2 months fees to the students.
This is what happens in India. Brilliant solution. Repay and then again account next year. IASB had a very interesting response. They said that, think of the year end. There can be a spillover of 2 months in the year end in some cases. That revenue should not be accrued on 31st of March. You should probably, in December in case of, foreign companies, that revenue should probably go to January or February or April and May, whenever it is required. The reason why I gave this example to you all is because they are trying to look at these standards in the minutest detail. Not only minutest detail, they are trying to also say that we are going to change these particular portions of the standards and it will come out as this thing here. It will come out as a amendment to the IFRS 115 or Ind AS 115. So I think that is what we should be a little bit careful about. We have an option in India. The option is, let's not break our mind on tuition fees. We'll do a carve out. That's one option we've got, because please remember that India has not implemented IFRS completely. We have gone by the not adoption approach. We have gone to the convergence approach, which means that we are going to, if required, we will find carve outs. Those carve outs will suit the Indian conditions. If necessary, we can suit the Indian conditions. In fact, even today, if you go and look at the IASB website or go to the IASB and say that I am a chartered accountant from Chennai in India, I have passed the Ind AS examination of institute, I have got first rank, rank but anyway, I have got flying marks. IASB says you are not qualified in IFRS. Have you done diploma in IFRS program? Officially, they don't look at this as a complete IFRS course by itself, because we have chosen the carve outs, though the carve outs are extremely limited and extremely less, but still they are saying that if you have the option for carve outs, you can obviously choose them whenever you want. You have not done a complete Pakistan approach, you have gone by your own approach, so therefore you are not completely complacent or completely compliant with your IFRS. This is what their stance is today is. In fact, in many of the cases, the IASB has said that, if you look at the examples they have given, Indian companies, in fact you look at, I think in 2005, SEBI came out with a circular in 2005, March, saying that any company which is listed on the Indian Stock Exchange, not 2005, 2006, sorry, 2006, any listed company, if they want to present as per IFRS, not, that time Ind AS was not there at all. If they want to present as per IFRS, they can present as per IFRS. Option given to you. When you give an option to Indians, what will they do? Whatever is beneficial we will take. The number of companies who actually transitioned to IFRS in 2006 were about 10 companies. Every single company listed on NASDAQ only. Your Infosys, your Rediff, your Dr. Reddy's Laboratories, those companies only. None of these companies actually did, they had their accounting standards, but when this option was given by SEBI, they said that we will transition to IFRS. Please, this is not Ind AS, IFRS. And before I hand it over to Venkat sir, I'll give this very interesting piece of information. IAS 39 was one standard on financial instruments, which was complex. IASB wanted to, as he said, simplify it. By simplifying it, they made it even more, I don't know, that Venkat sir will say, I don't, that's left to him. Because his topic is demystifying financial instruments. So he will decide that. But very interestingly, in 2009, Wipro was the first company to transition in India to IFRS 9 in December 2009 financial statements. No company across the world had probably implemented it completely at that point in time. Wipro said that we are anyhow doing it on NASDAQ. The standard is out now. The standard is already out now. We will implement IFRS 9 completely. From then onwards, they've been completely, converting to, not converting, they've been presenting as per IFRS 9. So many companies have done that also. Okay, so I think I will leave you all with this thought. I will now hand it over to Venkat sir because he's got a tight schedule. So I want you to have the full benefit of 2 hours with him, sir. Thank you.
CA Venkata Subramani. A brief introduction about sir. He is a graduate of University of Madras. He has over 3 decades of experience. Currently, Venkat sir is the founder of RVS Bell Analytics Private Limited, a company engaged in providing ECL and lease accounting on SaaS basis to several corporate clients. Venkat sir is engaged in IFRS, Ind AS services for several clients across the globe, specializing in accounting for financial instruments and lease accounting. He also conducts regular training for various corporate entities and banks on IFRS. Venkat was previously working with Calypso Technology, specialized in hedge accounting as per IFRS 9. Calypso is being used by several banks, financial institutions across the globe. Prior to this, Venkat was the head of business management and operations control at Northern Trust, Bangalore. Venkat sir also holds a diploma in IFRS from ACCA UK. He is also an All India rank holder in both CA and ICWA exams. He has an overall experience of more than 35 years. Besides, he has teaching experience across CA Institute and various banks. He has also authored several books. With this brief introduction, I hand over to Venkat. Thank you, sir. I request CA Balvendran to present a small memento. So, Venkat.
I think what he did was he actually underplayed himself because I used to admire. He will be in one city in one day. I don't know how he is able to manage. And on top of it, he is able to talk on so many subjects, not merely confined to accounting standards. Okay. And as I was listening today to him, the kind of examples that he gives is captivating. It's a real-time experience. That's what really matters. And okay, so today the topic is financial instruments, demystifying financial instruments. Now, I just want to give you a little bit of a background about this, in the sense that CA Institute is offering a course on financial instruments, which is called as Deep Dive Financial Instruments. I don't know how many of you are aware of that. This course consists of totally 2 modules, and each module 5 minutes of 3 hours each, which means totally the entire financial instruments gamut is covered in about 30 hours. 30 hours we cover this, and today 2 hours is allotted. So we'll try to do, I'm going to take some selective topics and try to deal with some of the interesting aspects of this, okay. Now before we get into the details, I just want to step back and then look at the genesis of these standards itself. So in the context of Ind AS, we have 3 standards, Ind AS 32, Ind AS 109, and we also have Ind AS 107. Now, as far as these 3 standards are concerned, these are the exact replica of the corresponding standards, which are IAS 39, which got replaced by IFRS 9, though not fully, because even today IAS 39 is still there, and IAS 32 and IFRS 7. Originally, these 3 standards, namely in IGAP, in our accounting standards AS 30, 31, 32 were there, and those standards were the exact replica of the corresponding standards as it stood in the year 2008 and 2009. 2008, 2009. It was supposed to become mandatory with effect from 1st of April 2011, and for whatever best reasons known, these 3 standards were withdrawn on 31st of March 2011. That means these 3 standards in AS never saw the light of the day. It never was mandatory at any point of time, even though some companies were adopting this in the because of the lack of corresponding standards. Now, as far as IAS 39 is concerned, he was mentioning whether the IAS 39 is more complex or IFRS 9 is more complex. I think, instead of comparing on those aspects, I would compare it this way. Generally, we all know that IAS is principle based, IFRS is principle based, whereas the corresponding FASB, that is the US GAAP, is all rule based. In spite of IFRS being principle based, IAS 39 contained several rule based items as well, and those were the primary things that were sought to be removed in IFRS 9. So when IFRS 9 was introduced, it came in about 4 installments. The first 2 installments came in 2009 and 2010 relating to classification and measurement, and 2013 was the one relating to hedge accounting. Hedge accounting, by and large, similar to FASB, that is US GAAP. Then in 2014, 24th of July 2014, IFRS 9 was fully announced, where the last installment relating to impairment was announced. At that point of time, the standard setters sitting on both sides of the Atlantic Ocean, namely FASB and IASB, they agreed to disagree on impairment. So which only means that the standard relating to impairment, or ECL, as far as US GAAP is concerned, is slightly different from the standard relating to in IFRS as far as ECL is concerned. We are not going to dig deep into it. Just keep this in mind, that these are not similar, whereas by and large hedge accounting is similar. Now let us get on to the core. We'll cover classification, classification of financial assets and classification of financial liabilities. I'm going to cover in reasonable length. Then we will also try to do ECL and an overview of hedge accounting. This is my agenda for today. Now, classification of financial assets. Assets, there are basically 4 types. Classification of financial assets. You have cash, and what is given below is the measurement classification criteria or the classifications. Cash is amortized cost. Now, in the earlier standard, that is IAS 39, we used to have what is called as HTM, held to maturity. Now, this is where I was telling about this principle based and rule based thing. Amortized cost is now completely replaced the earlier one, which is HTM. Now, HTM, what is HTM? Held to maturity. So, what is maturity? Held to maturity. How do you define held to maturity? Previously, they used to say you buy it with the intention of holding till maturity. So, what is intention? Very difficult to define what is intention. Okay, then you can say, okay, my intention is such a generic word, you can't define what is intention. Then, what is the ability to hold? Ability to hold. Intention and ability. So, how do you define ability? We can't say. So, somebody said, okay, if you have, say, 10 lakhs as your share capital, let me just give an example, and if you decide to invest the entire 10 lakhs, then there is really no ability to hold, because what will you do for your other day-to-day expenses, right? You will have to, what will you do for your other day-to-day expenses? So, obviously, you don't have the ability. You may have the intention, but you don't have the ability. So, this is the interpretation. But again, this is not final, because you can always borrow, right? For the purpose of day-to-day expenses, you can borrow. So, it goes on into an endless debate. So, for that purpose, they made this into a principle-based thing. So, what is amortized cost? We will see. What are the principles behind that? We will see. Now, as far as equity investments is concerned, there is no question of getting it back from the company. You will get it back from the company only once, when the company goes into the liquidation. Otherwise, you can't. So, which means you can always sell it in the open market, in the secondary market, or you can keep buying and selling. So, obviously, there is only one. So, you can buy it, hold it for a reasonable period of time without the intention, without, I won't use the word intention, without buying and selling, or you can keep buying and selling. So, these are the two choices that are available, with you to classify this as either FETPL or FEOCI. Debt instruments. Debt instruments, you have all the three varieties. So, you can buy a debt instrument with the intention, or with the purpose of holding it for the collection of interest and principal, or you can keep buying and selling, or you can buy it and you can sell it only once whenever you find the time opportune. Okay, we are going to see the classification criteria a little later. And the derivative instruments, all derivative instruments without exception has to be valued at fair value, and it should be taken to the P&L. So, this is the broad guidelines. Okay, we will see, we will go more deep into it now. So, the first type of financial asset we are going to see is the investment in equity securities. So, investment in equity. So, I told you that there can be only two types. One is either you hold it with the purpose of holding it for some time, not with buying and selling. So, here the first question asked is it held for trading? If it is held for trading, then the classification is FETPL. If it is not held for trading, then the entity has a choice to say that I want to treat it as FEOCI. The entity has a choice, and this choice can be exercised by the entity at the time of inception. That is, at the time of buying it itself, you have to exercise this choice, and once the choice is exercised, it is irrevocable. You can't say at the end of the year, no, I want to treat it as FETPL. That is not possible. This is an irrevocable choice, and this choice can be exercised on an instrument by instrument basis. So, this is called FEOCI for equity instruments. Now, if it is held for trading purpose, then obviously it will be FETPL. So, the fair valuation should be done in both the cases, and you have to take it to the P&L if it is held for trading purposes.
By treaties of first lot I buy today, I have one treatment. Same instrument I buy it after 6 months. I have a different.
100% it is possible. So, even on the same day, you buy 100 shares of Infosys, you may say 50 shares or 60 shares I want to treat it for trading purposes, 40 shares I want to keep it for, I want to exercise the choice as FVOCI. Okay. We'll come to that. We are going to debate a lot on this one. Okay. So the next is, if it is not an equity instrument, obviously it is a debt security. So the first question is asked is, what is the nature of the contractual cash flows? So are all the cash flows arising, contractual cash flows arising on account of this instrument purely for, solely for payment of principal and interest? So that is the next question. Okay, the first question. Now, if the answer is no, then straight away it will be treated as FETPL. That means you have to do the fair valuation of the instrument. Now, if the answer to the first question is yes, which means if the contractual cash flows represent purely or solely payment of principal and interest, then you move on to the next question, which is, what is the business model objective of holding this? Okay, whether you hold this to collect only contractual cash flows, or you also want to sell at some point, which means not buying and selling just once. You can exercise this choice only once, which means whenever the time is opportune, whenever the time is favorable for me, I have the choice to sell it. If that is the case, then it will be treated as FEOCI for debt securities. If the second one, if the answer to the second question is no, then you see whether it is held for the purpose of selling just once. If it is for once, then it is FEOCI. Otherwise, it will be treated as amortized cost. Now, the amortized cost is the most coveted class because you don't have to do any fair valuation of the instrument. So everybody wants to value this on a amortized cost basis. That is the reason why the classification criteria is very rigorous. The classification criteria is based on applying a set of principles, and it is not arbitrary. That you can't suddenly say, okay, I want to treat this as amortized cost. Now, I want to make an analogy. I want to compare this with IAS 39, even though my intention is not that. Okay, I just want to give you an example here. In IAS 39, in the school, when I was in the school, okay, 5th standard, 6th standard, okay. So I'm 64 now, so you can just imagine. Okay, when you make a mistake, the teacher used to have a foot ruler, scale. So say, show your hand. Today, that's out of question. Okay, you can't even scold. Wait. So now, show your hand. So you show your hand. Before hitting, the teacher will say, show your knuckles, because it will pain even more, right? Show your knuckles. I don't know how many of you have experienced this. People of my age would have, yeah. So drawing the same analogy here in IAS 39, you have some investments which you have classified as HTM, which is the equivalent of this amortized cost, and then you sell some of those. You are not supposed to sell it, right? You have to hold it till maturity. So you have the ability to hold it till maturity. So you are supposed to hold it till maturity, but you don't. So you have sold something. Then the regulator will say, show your hand. So that means you have to transfer all the balance investments in HTM to trading. That means you have to do a fair valuation of the entire set, even though you violated only for some portion. That is showing your hand. It doesn't pain much, right? So you have to show your knuckles. So the regulator said, no, you cannot have any classification under HTM for the next 2 years. For the next 2 years, you are debarred from classifying anything under HTM. Now, those are things of the past. Don't worry, it is not relevant for us. But I just want to tell you how it got marked, how this IFRS 9 is really a simplified standard. So the conclusion is IFRS 9 is really an excellent standard, or simplified standard. And we, especially when it comes to hedge accounting, I'll talk more about it when we talk about hedge accounting, how IFRS 9 is a real boon, which is not the case with IAS 39. Now, one thing I can tell you here is that, we are all very fortunate. Being in India, we are very fortunate because we are introduced to Ind AS 109 directly. In 2014-15, we were introduced to Ind AS 109 directly. We never had to go through the rigmarole of unlearning IAS 39 in order to learn IFRS 9. Okay, so to that extent, we are all very fortunate. We only have to know about Ind AS 109. Now, are you able to see the bottom line? So FVOCI exercising the option, FVTPL is the residual class, FVOCI debt securities is by applying an objective set of criteria. Similarly, amortized cost is applying a set of objective criteria. Okay, now we will deliberate a little bit about, in the interest of time, we are going to deliberate a little bit about the contractual cash flows, solely payment of principal and interest. What is interest? Interest predominantly represents the time value of money. Interest predominantly represents the time value of money. It also has some element of the amount relating to the liquidity risk and the credit risk. And finally, there is also an administrative margin that can be added. So these are all the four major components of interest. The primary component is time value of money. Okay. Now, the first test, which is the SPPA test, is done at the instrument level. That means, supposing I am holding the debentures of, say, Tata Motors. And what do I get from the debentures of Tata Motors? I get interest, the stated coupon, whatever is the stated coupon, 6%. And I also get the principal. Supposing the maturity date is 2030, then I will get the principal back in 2030. So what are the streams of cash flow that I have? Interest and the principal. Interest at the respective date. So this passes the test. It passes the test for me, for you, for everyone. At an instrument level, SPPA test is passed. But then I may hold it with the intention of, with the purpose of buying and selling. That means I may hold it for trading purposes. In that case, I have to value this on a fair value basis. Or I may hold it till maturity. That means I am not bothered about the value, present value of those. I am just bothered only about collecting the cash flows, which is interest, and the principal at the end, which means the second principle, that is, it passes my business model objective is to collect only contractual cash flows, right? And the third one is, sometimes I will find that the value of this Tata Motors debentures may go up and down. When it will go up and down? Because this is a fixed rate investment, and if the interest rate moves up and down, the value of my bond, the value of the debentures will also go up and down, right? So when the interest rate goes down, the value of my investment will go up. So that is an opportune time for me to sell. I may sell. Okay, I have the choice to sell once. If I find that the rate is very good, then in that case I have to treat it or classify it as FVOCI. Okay. Now this is the broad outlines. Any questions on this? I'm happy to take. But I have one question for you now. Okay. So these are the examples. Okay, how it is treated. So in the case of amortized cost, you don't have to do the fair valuation of it, right? You only have to consider the interest, etc., to be accounted in the P&L. Okay. Now these are examples. I have already given what constitutes interest. Interest is the time value of money. It also has a component relating to credit risk associated with the principal outstanding, and it includes basic lending risk, liquidity risk, etc. And predominantly it is time value of money. Okay. Now I can also give one example where the test, the SPPA test, does not pass. Like, for example, you make an investment in ABC Limited. Okay, ABC Limited offers interest at the rate of, say, 20% if the Nifty stays above 25,000. If the Nifty falls below 25,000, they say I can pay interest only up of 15%. In that case, this is not the first test, SPPA test is not passed. Okay. Don't confuse that here also it is a percentage, interest is mentioned as a percentage, that is not the matter. It is only a measure to find out how much to be paid, but again that is not the predominantly a time value of money. Okay. So in this case, SPPA test is failed. Is it clear? Okay. Now I am going to ask you one question here. This is the question. If you are able to answer this question, you have understood the classification in full. Now there are two types of FVOCI. One is relating to equity, another is relating to debt securities. Okay. Now the use case here is you purchase at 100 rupees, then at the end of the first year, the fair value is 115. So both has to be valued at fair value because it is FVOCI. 15 rupees is transferred to OCI in both the cases. In the next year, the value goes up to 125. So 10 rupees is the additional or incremental amount that is transferred to the OCI. Third year, it is sold, liquidated. So at 130, so 5 rupees is the gain. So the net OCI is 30 rupees. And in the case of equity instrument, the 30 rupees remains in OCI, whereas in the case of debt security, it is plowed back to the P&L. Now this is the rule, this is the law. Now I am going to ask you, why is this? Why in the case of investment in equity instruments, at the time of sale, the profit that is moved to OCI remains in OCI, and why in the case of debt securities it is plowed back? Now the reason why I am asking this question is this: if you are able to answer this question, the classification criteria is completely understood. Can you make some? Huh? Not in the case of equity instrument. It is not transferred. You can't. There is no choice. You can't. This is the rule. I am going to explain why. This is the rule. In the case of debt securities, it has to be transferred to P&L. It has to be recycled back to the P&L.
Because in case of debt securities, interest income is recognized in the P&L, so that may be the reason we have put it reversed to the.
Okay. Any other answers? Okay. I will facilitate. Retained earnings. P&L. Yeah. Retained earnings is part of your OCI only. It's a yeah. Yeah. It doesn't come to the P&L. It doesn't come to the P&L. That's the point. Yeah, you are right. Absolutely correct. Well, can you tell me why? Huh? Principal is actually the value, no? See, whatever, see 130, why it goes to 130 debt security? It is because of interest rate fluctuations, right? So you get that. Is it clear? No, my question is not answered. So, yeah. Okay, let me ask in a different way. Okay, my question. First, there is a choice that can be exercised by the investor when an investment is made in equity securities, right? What is the choice? The choice is to have it either as FVTPL or FVOCI. So long as it is not meant for trading. If it is meant for trading, it has to be FVTPL. Let us assume it is not meant for trading. Why would an investor exercise this choice? What is the reason? What is the motive behind this? Huh?
Interest in the organization, ownership, the motive behind holding
Equity investment, there is no interest income, no? It's only dividends.
I meant the gain out of the equity instruments are usually long term.
Long term. No, but okay, so that is the reason why you want to treat it as FVOCI? Is that the motivation? What is the motivation behind classifying this as FVOCI?
I don't see regular income from the equity.
Okay. Any other straight answer? Very simple answer is that, no?
Return on debt is generally contractual based. The return on equity.
No, I'm not asking. Don't go to the first question. I'm going to the second question, simpler question. Simpler question is, what is the motive behind somebody exercising the option to classify this as FVOCI? Huh? No, not tax. Huh? Exactly. Fluctuations, to avoid fluctuation. Avoid fluctuations in P&L. That is the reason, no? Because you don't want to show unnecessary fluctuation, because amortized cost, as I told you, is a coveted class. Because there is no fluctuation, you are not required to do the fair valuation. Here you do the fair valuation, but it is not taken to the P&L, it is taken to the OCI. So the CFO problem, there is no problem for the CFO, right? Okay. Now let us try to extend this. If you say, think about it logically, if you say that you don't have to show this in P&L because you have already classified this as FVOCI, so long as you hold it, but if you liquidate it, it has to affect the P&L, then the very purpose of classifying this as FVOCI is lost, right? You understand the reasoning why it is? Is the answer clear? So the very purpose of classifying this as FVOCI is defeated if the rule says that you have to classify it back to the P&L. Okay. Now, can you answer the second part? Why in the case of debt security it has to be transferred? It can't be left in OCI. It can't be left in retained earnings directly. As in the case of equity, it can't be taken directly to equity. It has to come to the P&L. Why? The answer is not the same. Answer is different. Question is the same. Answer for both are different. Any guess? Okay. Now, first, this is the reason why we can deliberate more about the FVOCI, because this FVOCI classification comes where the first test passes. That means whatever the contractual cash flows represents only payment of principal and interest. First test is passed. Okay. Now the second test is you have the right to sell. You have the right to sell when? Only once, because if that is exercised, it is sold already, right? You have the right to sell once, whenever the time is opportune. You are not going to buy and sell back. So I may sell today, I may sell tomorrow. So at the date of the balance sheet, so on 31st of March, the investor would like to know what happens if you have to sell today or tomorrow. So what is the value? So that is the reason why it has to be valued at fair value. Okay. As against the amortized cost, where you are not going to sell it. You are going to sell it. You are going because your primary motive is to collect only contractual cash flows. You are not going to sell it, right? So you don't care about the value. You don't care about the fair value of the instrument as on the balance sheet date. Whereas here you have. Now, what is the coral? What is the other side of the same coin? The other side of the same coin is your profits, right? Profits or loss on account of that investment. Now, if there is a profit, in this case, like for example, this 15 rupees or this 30 rupees or 15 rupees belongs to the owners, right? It is a part of the net worth of the entity. It is a part of the net worth of the entity. But it is not yet realized. While it is part of the net worth of the entity, it is not yet realized, so it has to be part in the other comprehensive income, because as an investor, I would like to know how much it would fetch if it is sold the same day or the next day, but that is not yet realized, so it has to be kept in OCI. But when it is realized, the event has already occurred. The event of what? The event of selling has already occurred, so obviously it has to be reflected in the P&L. So that is the reason why at time of sale, it has to be transferred to the P&L. So answer clear? Okay. Now let us come. This SPPA test. I'm skipping all available in our material. Okay. I have already shared the PPT. Okay, I want to go for something interesting now. Financial liabilities. Okay, we will, I think, need a 10-minute break for tea, I think, no? 15 minutes, okay. So we will have tea and then go to this. Very simple, it is not such an elaborate exercise as classification of financial assets. We have only two classification. One is FETPL, the other is amortized cost. So generally, all the exposures are amortized cost only, unless it's a derivative or it is held for trading purposes. So amortized cost. Now, amortized cost liability means what? So I hope you are all aware of this EIR, right? Effective interest rate. Supposing I will give an example of purchase. Okay, investment. Okay, for financial assets. Supposing you are buying a debt security at a discount of say 10 rupees. So you're buying it at say 90 rupees, and or say 85 rupees. For a period of 5 years, and you are going to get back from the company 100 rupees, right? So 85 rupees is what you have invested now. So 15 rupees previously what we used to show under AS is we used to show this as what? As capital gains, right? 15 rupees is capital gains. Now that is not allowed as per Ind AS. You have to find out what is the effective rate of interest. So obviously, supposing the interest paid, the coupon is say 6%. Taking into account this 15 rupees, the coupon rate may become 10%. Now you will effectively the interest rate can be 10%, which means over a period of time 85 rupees keeps on growing, and finally it will grow to 100 rupees. Is that concept clear to you? Effective interest rate concept. Okay. So if I start with 100 and my maturity value is 100, every time I will show only 100, correct? Because my effective rate of interest will be the same as this thing. So your initial starting point is 100 and your maturity value is 100. Every year you will show what? Every year you will show only 100 rupees, correct? Is that concept clear to you? Is it clear or not clear? So if you start with 85 and the maturity value is 100, 85 keeps growing every year. Right? That's a simple thing. I am just giving this as a background because I want to ask one question based on this, that's why. Okay, now let us take a case where there is a debt security. Okay, this debt security, fixed rate exposure. 8% is the fixed rate. 8% is a liability. 8% is a liability. So this will be classified as amortized cost. Okay, because it's not a derivative, and you are not going to buy and sell this. Right? So obviously the classification is amortized cost. Now, how did you arrive at this 8%? 8% you arrived at based on the credit spread of 2% and the risk-free rate is 6%. So that's how I came up with 8%. Right? And the issue date is 1st April 2015, maturity date is 31st March 22. Example, 7 years. Now, in this kind of an exposure, when the CFO came up with this kind of an exposure, the chief economist said the interest rate from 6% is going to go down. In 2015, he said, 2015, the chief economist based out of London, the chief economist warned, in India, the interest rate is going to go down from 6% to 4% or 3% or whatever. Okay. So what is the point in taking a fixed rate exposure? You know pretty well it's going to go down. So the right choice would be what? Should have a floating rate. So FRN, floating rate note. But the CFO said, come on, if I come up with a floating rate, nobody is going to subscribe. I have to come up with a fixed rate only, fixed rate bond only, right? So the CFO has no other choice other than to come up with this. Then the CFO tells, okay, don't worry. If you think that the interest rate is going to go down, what I can do, I can take an interest rate swap. I can swap this fixed rate exposure to a floating rate exposure by taking an interest rate swap for the same notional of 100 crores is my notional, for the same notional 100 crores, where I will receive 8% because this is what I am paying, 8% is what I am paying. So I will receive fixed rate of 8% and a floating rate which will be tied to the benchmark rate. So what I have done, I have converted my fixed rate exposure to a floating rate exposure by the help of an interest rate swap. So the interest rate swap, fixed rate, what you receive is a fixed leg, okay, and what you pay is the floating rate, and what you have given on the right side is the fair value of the swap. Now, I'm sure all of you understand what is an interest rate swap, right? So interest rate swap has got two legs, okay. One leg is a receive leg, the other is a pay leg. Receive leg, pay leg. So usually one leg is a fixed rate, the other leg is a floating rate. Both can be floating, right? Because both can be based on different benchmarks. Both can be floating. Can both be fixed? Can both the legs be fixed? Unless you have no other job, right? So I will receive 5%, I will pay you 5%, right? No, that's not the case. There can be where it is tied to different currencies. So I pay 2% on USD and I receive 10% on INR, or I pay 10% on INR, I receive 2% on USD. USD means what? Tied to USD, it could be SOFR plus whatever. Now, this instrument, what is the purpose of this instrument? The purpose of this instrument is to convert your fixed rate exposure to a floating rate exposure, because the chief economist thought, or the chief economist is of the view that the interest rate is going to go down. But actually it didn't happen, right? The floating rate, you see, it went down for some time and then they actually went up. Okay. So chief economist is not a god, no? He is just another professional, and there is a 50% probability that he will go wrong, right? So by virtue of taking this instrument, are you assured of reducing or minimizing your interest? No. 50% chance? Yes, because he is an economist. Okay, fine. Now, let us look at the flip side of this. Now, this is a derivative instrument. Interest rate swap is a derivative instrument, and the fair value of the swap has to be recorded. You have to record the fair value of the swap. And what is the corollary of this? So the fair value is positive. Why it is positive? Because the interest rate went down the next. So the payment, you have to pay less 6%. So obviously your payments are going to be less, and what you're going to receive is 8%. So obviously this will be a profit to you. It's an asset for you. So 9.83 crores is the fair value of this instrument, which will be recorded in the balance sheet as a asset. And where will the other aspect of it recorded? Because it is a derivative instrument, it will be taken to the P&L, right? So what is the effect of taking this instrument? The effect of taking this instrument is you started with 0 as the fair value, because fair value of any swap at inception is 0, and the fair value of any derivative at the end is also 0, because there is not going to be any cash flows associated with it. So you start with 0, end with 0, but unfortunately during the entire course it has an up and down, right? So 9.83, second year 12.99 becomes 6.93. So from an incremental point of view, the P&L is going to be affected. First year you are going to have a profit of 9.83. Second year there is going to be a profit of how much? 12.99 minus 9.83. Second year there is going to be a loss, 6.93 minus 12.99, like that. But the sum total of all this for all the years put together, 7 years put together, will be 0. So unnecessarily there is a fluctuation in the P&L. Now this is what is called technically an accounting mismatch. So this is what is called as, and what is an accounting mismatch? An accounting mismatch is where I have two instruments. Now before I go to this, I just want to ask you, in the second year the interest rate came down to 8%. From 8% it comes down to 6%. So what will be the value of the liability that will record in the balance sheet? 100 crores. The value, when the interest rate goes down, the value? When the interest rate goes down, the value increases, right? So it has increased, it obviously the debt security also should increase, the value of liability should also go up by 9.8, right? 109. How much it will be recorded in the balance sheet? I have told you the number also, 109.83 number I gave you. How much it will be recorded in the balance sheet? So interest rate goes down, the value of the liability goes up, and by virtue of the swap, I know that the value should go up 9.83. So the liability from 100, it becomes 109.83. How much it will be recorded in the balance sheet? I have given the answer also, no? That is the wrong answer. That's why I said. It will be recorded at 100 crores only because it is an amortized cost. So the first question I said, I will ask a question based on this, right? So you started with 100, you are going to end with 100. So throughout the year, how much you will be showing in the balance sheet? It will be only 100. So you are not bothered about that, right? So on the one hand, there is no fluctuation coming into the P&L on account of the debt security, whereas the corresponding instrument which has the purpose of converting the fixed to floating has a problem from an accounting point of view, because it is going to show some fluctuations in the P&L. So it is an accounting mismatch. So what is an accounting mismatch? An accounting mismatch is one where there are several other examples of accounting mismatches. Okay, this is one of the cases. This case is where there are two instruments, where the two instruments should be taken together and not to be seen in isolation. One instrument is having a classification of amortized cost, other instrument is having a classification of FVTPL. So there is an accounting mismatch. So how to solve this accounting mismatch? Very simple. The standard gives you a wonderful option which is called as fair value option. So you can, at the time when you entered into this debt security, you can say, I want to value this on a fair value basis. What are the conditions? The condition is, first, there must be an accounting mismatch. Yes, there is an accounting mismatch because I am also taking a derivative, interest rate swap. There is an accounting mismatch. First condition satisfied. The second condition is, it must be mentioned at the time of inception. That means you can't say after 1 year, no, I want to go back, I want to say this should be valued, I want to exercise no. It should be done without undue delay. Then the third one, which is a draconian provision, is that it is irrevocable. Okay, just keep in mind, I'll tell you why it is draconian. It is irrevocable. Okay, now what happens when you exercise this option? Your fair value of the swap, okay, so you have the fair value of the debt security, okay, fair value of the debt security is going to show a loss. Fair value of the derivative instrument is going to show a profit of 9.83. Fair value of the debt security is going to show a loss. It will become 0. So obviously your net effect of both this put together will become 0. So your fluctuations in the P&L is completely nullified. Am I right? Are you all with me how this problem is solved? Any doubts on this? Any questions? Please ask me. Want me to explain again? Originally we had fixed rate exposure. This fixed rate exposure has a problem because interest rate can go down. So the CFO decided to go in for a swap to convert the fixed rate to a floating rate. The floating rate, this swap instrument is a derivative instrument which has to be valued every quarter, every year, and you start with 0, end with 0. Intermittently there is going to be a fluctuations. There is no fluctuations coming to the balance sheet from the derivative, from the fixed rate exposure, because it is an amortized cost instrument. So there is a problem with on account of this interest rate swap. There is an accounting mismatch. So in order to solve the accounting mismatch, the standard gives you an option. This is a choice. The choice is given to you to value the debt security on a fair value basis. So if you do that, obviously there will be profit or loss coming from the debt security to the P&L. Similarly, profit or loss coming from the derivative instrument as well, which will nullify each other, and eventually it won't be exactly zero, it will be probably a few thousands or whatever. Is it clear up to now? Okay, now let us see what happens. Now this guy, okay, so this is the FEO choice, okay, FEO choice, your P&L impact, you can see the last column P&L impact is 0, okay. But you know what happened, in the second year, the value of my swap is 12.99 crores. So it looked very attractive to the treasury. What the treasury people did, the treasury people sold or liquidated it's called termination. They terminated the interest rate swap. They terminated the swap. So when they terminated the swap, okay, what happened? There is no there is no fair value changes coming from the swap to the P&L, but there will be some fair value changes coming from the fixed rate exposure because it is valued on a fair value basis and the choice is irrevocable. So you can see here, there is you can see on the last but one, which is the NPV of the debt. Okay, the NPV of the debt is going to impact your P&L. So the P&L again is going to show fluctuations. So what you thought is the remedy is actually worse than the disease, right? So here, fair value option is definitely not the best choice. Do you understand why fair value option is a draconian thing? Because it is irrevocable. You can't say, no, I want to go back to. Is the solution clear? Okay. Now, let us see what happens. These guys, the CFO found out that the swap is liquidated, the swap is already terminated. So there is a debt, and the value of the debt is derived based on what? Based on the underlying benchmark interest rate plus the credit spread. So if the interest rate goes up, what will happen to the value of the bond? The value of the bond will come down, right? So how to increase your rate? There are two ways. One is benchmark. You don't have any say. You can't increase the benchmark rate, right? It is determined already. But you can increase the credit risk, right? So what the CFO did, the CFO didn't come to the office. Every day he goes to the club. He stopped coming to the office. So the perceived risk of the company increased, as a result of which the value of the debt security, what happened? When the interest rate goes up, the value will come down. So when the value of the debt security comes down, what will happen? There will be profit, because there is no profit or loss coming from the swap side, because swap doesn't exist. So the next year the CFO made even more profit. Then the CEO also got a clue. He said, okay, why don't I also join you? So both of them go to the club every single day, and they increase the credit risk. They made more profit. So they make more profit, they enjoy, and then they started. Is it correct, or am I blabbering something? What I'm saying, does it make sense, or something is wrong somewhere? You can't go to the club and make profit. No, every single day, both the CEO and CFO, they're increasing their credit risk and still they make profit. So where is the problem? Is there any problem, or everything is correct? 90 hours they don't work. Actually, they go somewhere else. No, we are assuming the interest rate. No, we are assuming the interest rate is constant. See, this is a hypothetical situation where the interest rate is the same. So how to reduce the value of the liability? By increasing the rate. So the rate consists of two components. One is the benchmark rate. The other one is your credit spread. So if your rating goes down, obviously your credit spread goes up. So the value at which you will discount will also go up. So the value of your liability will go down. Interest rate goes up, value of the liability goes down. Is there anything wrong, or it's correct? So you've completely lost trust in me, right? Okay, I've become unpredictable now. Okay, I mean, I always take to that level only, everybody. Okay, now I'll tell you, there's nothing wrong. It's perfectly correct. You can trust me, it is correct. Okay, but then this was a very big lacuna. Okay, this was plugged in 2013. This loophole was plugged, and then they said that whatever is the increase or decrease of the liability on account of the own credit risk, here it is entity's own credit risk, should be taken to the other comprehensive income and is never ever plowed back. It remains in OCI, which means that you don't make increase in your EPS. So only if there is an increase in EPS, the CFO is rewarded, CEO is rewarded. So, or the markets obviously react favorably to that. Nothing happens of that because it directly takes, it goes to the OCI. So that loop is plugged. Is it clear? Okay. Now, I want to tell you how can this problem be solved? There is a genuine problem. No, what is the problem? The problem is there is a genuine problem, right? What is the problem? I have a fixed rate exposure, and I want to go in for a derivative instrument, and there is a possibility that the derivative instrument can be terminated by the treasury for whatever reasons. So I have a genuine problem. So how to solve this problem? That is where hedge accounting comes into play. Okay. So if you follow hedge accounting, then you will actually revert back to measuring this on an amortized cost basis. Measuring what? Measuring the fixed rate exposure on an amortized cost basis. Okay. Now we'll talk. Now we have completed this liability, and I'm going to dovetail this into hedge accounting so that we can complete that as well, and then take up ECL. Okay. Now hedge accounting, we need two instruments. What is hedging first? What is hedging? What is, or I'll put it this way, what is the objective of hedging? Covering the risk. Minimizing the risk. Can we say minimizing the risk? Minimizing the loss. Can we say minimizing the loss? Then the second objective?
Increase profit.
So never trust my action, okay? The second thing. So I purposely do the action to get these words from you. So the second objective is not to maximize profit. It is not an objective. The second objective is to protect the unrealized profit. That is the second objective. There are only two objectives. First objective is to minimize your loss, or you can say minimize your risk or minimize your loss. The second objective is to protect unrealized profit. Second objective is not to maximize profit. You wear a helmet to protect against yourself, not to drive fast. This is the example that is given. Okay, so you wear a helmet for what? Only to protect you, not to drive fast. Okay, now what is meant by speculation? First, superb. Directly he gave the answer, giving me no scope for any comments. So, okay, you have an underlying, you take a position in the derivative segment which is opposite to that of the underlying is what is called as hedging. You have an underlying, you take a position in the derivative segment which is opposite to that of the underlying is called hedging. You don't have an underlying, you take a position in the derivative segment. Which direction? Same direction, opposite direction. There is no direction because there is no underlying, right? So any direction you take, it is speculation. What is gambling? Don't say three cards. Huh? Now I want you to extend this. Okay. Now can I ask you one question? What is meant by open interest? Are you aware of what is meant by open interest? In the context of derivatives, what is meant by open interest?
Loss can be.
No.
You have kept the option open.
Who said that? Exactly. So open interest is the total number of outstanding contracts at any given point of time before the date of settlement or at any point of time. At any point of time, the total number of contracts outstanding. Okay, in the derivative segment, what happens? See, in a cash market, supposing you are trading in say Tata Steel, for example, okay. Let us assume the total number of shares issued by Tata Steel is say 1 crore shares. This is actually much more for the sake of discussion, 1 crore. So what is the maximum number of contracts that can be shares that can be sold in the bought or sold in the exchange? 1 crore. That's the maximum, right? You can't. Now, in the case of derivatives, whether it is an options or a future, the buyer and the seller come together and then they form the contract. They are creating the market, they are creating the contract. And if they, buyer and seller, come together and make a contract for 100 shares, 100 shares is the open interest till it is squared off on the date of settlement. So theoretically, the outstanding, that is the open interest, can exceed 1 crore. While in the cash market it can't be more than 1 crore, in the open interest theoretically can exceed 1 crore. Are you with me? Because the buyer and the seller come together, right? So now answer what is meant by gambling. I have given you some clue. What is gambling? So extend that. In the case of hedging, you have an underlying. You take a position in the derivative segment. Opposite to that, the underlying is hedging. Speculation, you don't have an underlying. You take any position in the derivative segment is speculation. In the case of gambling, also you don't have an underlying. You take a position in the derivative segment, but the total open interest exceeds the underlying. So if the open interest is 150 crores and the underlying is only 100 crores, to the extent of 50 crores it is gambling. So when you take a position in the derivative segment, either a call option or a put option or a futures or whatever, do you know whether you are speculating or gambling? You don't have an underlying. Do you know whether you are speculating or gambling? You will never know, no? Who will know? Who will know whether you are speculating or gambling? The regulators will know, right? The NSE will know, BSE will know, SEBI will know, because they know what is the total open interest, what is the underlying, what is the total open interest. Then they will know whether it is speculation or gambling, right? So that is the reason why not only in India, anywhere in the world, in an exchange traded environment, the total open interest cannot exceed 80% or 90% of the underlying. In India it is 80%, in UK it is 90% and things like that, okay? But all over the world, in an exchange traded environment, the open interest can never exceed the underlying. It will only be so which means in an exchange traded environment, there cannot be any gambling. At best, there can be only speculation, there can be no gambling, okay? Where can there be gambling? Can there be gambling anywhere? In the financial markets. Can you think of some area? See, have you heard about CDS? Credit default swaps. Credit default swaps, see, demystifying financial instruments without knowing this. That's why I'm telling this, okay? So this is, credit default swaps is a type of animal where, let us assume I am in the US, okay? Imagine I am in the US and I hold 1 million worth of bonds. Bonds are like debentures issued by Microsoft Corporation, maturity 2030 and paying a coupon of 6%. I own 1 million worth of bonds issued by Microsoft Corporation with a maturity of 2030 and paying a coupon of 6%. What are the types of risks I am exposed to? Interest rate risk primarily, forget that, we are not talking about that. From a credit point of view, what are the risks that I am exposed to? The credit risks are, Microsoft may not pay me the coupon, on time, may not pay the principal in 2030, may not pay the principal on time. Credit rating of Microsoft Corporation can go down. Today it may be AA. Tomorrow it may go down to B or C, whatever. So when the credit rating goes down, obviously my value of my investment will also go down, right? These are the credit risks I'm exposed to. Now in order to avoid this credit risk, I can buy an instrument called CDS. So that's basically to buy protection. So if I have CDS, then all that I have to do, if the credit rating goes down from say AA to C, for example, the value of $1 million, 1 million worth of bond will go down to say $200,000. From 1 million it will come to 200,000. So in that case, I don't have to worry. I only have to find out where the seller of the instrument is. The seller will be hiding somewhere, right? So all that I need to do, I have to carry the bonds with me and then find out the seller and throw it on his face. What will he do? He has to pay you $1 million. But he won't pay unless you throw it on his face. I'm saying throw it on his face to make the point very clear that he has to deliver. You will understand that. That is why I'm saying these words. You have to deliver that 1 million worth of bonds, then he will pay you 1 million, irrespective of what the market is. Now this is called as CDS. Now I am having 1 million worth of bonds. Can I buy 5 million worth of CDS? Can I buy 5 million worth of CDS? Can I? Are you with me? Or totally lost? Huh? Can I buy or not? Why? No, we are not there yet. We'll finally end up there. Okay, we are not there yet. What's the car you drive, sir? Mercedes 500? Assume you are driving Mercedes 500. 500, yes. 4.5 crores. Can I take insurance on his car? Can I? Come on, I'm buying. So if I'm allowed to take insurance, what I will do to his car? I'm not going to do anything, don't worry. Right? So what is lacking there? Insurable interest. That's what you wanted to say, I know. Why you stop? Insurable interest. So there is no insurable interest. So I own 1 million worth of bonds. Can I buy 5 million worth of CDS? There is no insurable interest, no? Only to the extent of 1 million I have, right? So will I be allowed? I have told the answer. Will I be allowed or not? Now you are not even answering because you can't trust me now. Please answer. Will I be allowed or not? I don't have insurable interest. So I can't buy. Okay. Now I will ask another question. I own 1 million worth of bonds. Can I buy 10 million worth of CDS? This fellow has gone mad now, you know for sure. 5 million itself, the answer is no. How can he buy 10 million? Okay. Can I buy 100 million worth of bonds? Definitely answer is no, right? Unfortunately, in America, the regulators don't think so. So you are allowed to buy. Even today, you are allowed to buy. Now in 2007, 31st December 2007, the total value of the corporate debt, which is the underlying, corporate debt is the underlying for CDS, right? The corporate debt was $25 trillion. $25 trillion. And on the same day, the total open interest on account of the CDS was $62.5 trillion. Open interest was $62.5 trillion. So the difference between $62.5 trillion and 25, $37.5 trillion, what is that? What is that? Gambling. That is the reason why we had the financial crisis. In India, we never had financial crisis. Why? Because do we have CDS in India or not? Do we have CDS in India? CDS instrument do we have in India? Okay, in 2007 we never had. So that was the reason why India is saved from the financial problem. financial crisis, India was not affected primarily, not like US. So 2000, we all went to RBI and then asked, we want CDS. So RBI said no. 2003, 2005, continuously rejected. Then 2011 October, it was allowed. So from 2011 October, we have CDS, but with two primary conditions. One condition is that I can't buy CDS more than whatever underlying I have. That means my open interest will always be less than this, right? So there is an insurable interest concept. That is first, number one. The second one is the person who is selling the CDS, the seller, the writer of CDS, has got to be a regulated entity. It has got to be regulated by IRDA if it is an insurance company. It has got to be a bank regulated by RBI, or it has to be a broker regulated by SEBI. So this is the condition. So these are the two conditions. So that ensures that we have a very robust market here as far as CDS is concerned. Okay. Now, the reason why I am saying this is that, so there has got to be two instruments. One is the underlying, the other one is the derivative instrument, right? Now, in the case of the interest rate swap, there are two parts to it, right? One is the receive leg, the other is the leg. Here, even in our own case, you can see that the value of this interest rate swap moves from profit, moves from loss. You can see the fair value column on the balance sheet. Initially, it was an asset. From the asset, it moved to a liability, right? Depending upon the interest rate movement, it can be an asset or it can be a liability, right? Now, there is a possibility that you can make, you end up paying more interest because of converting this, correct? You can end up paying more interest, no? Right? If the interest rate can move against you, you end up paying more. So 50% of the time, you can assume, generally, 50% of the time, you will actually be paying more interest than what you originally thought. Or you will be better off not taking the instrument. Am I right or wrong? Are you with me? You are better off not taking the instrument. So in that case, what is the purpose of hedging? The purpose of hedging, what is the objective of hedging? Minimizing the risk. Am I minimizing the risk? I am not minimizing, no. 50%, if you say 50% of the time I will be minimizing the risk because of taking the interest rate swap, is it a hedging instrument at all? Are you with me? Or is the question clear to you? There is a 50% possibility or probability that I will end up paying more interest than what is originally my commitment, right? Because of taking this instrument. Only 50% of the time, on an average 50%, there is a 50% probability they will make money. So if you say that this instrument gives you a protection against the interest only for 50% of the time, am I really minimizing my risk? How do you say yes?
So the other 50% on the volatile interest is going down also is there.
Yeah, no, but I can't say 50% of the time I am better off, 50% of the time I am worse off. So how can you say I am minimizing the risk? Minimizing means you have to minimize all the time, no? That is the objective, right? Okay. In the case of options, you are actually doing that. You minimize. So your total cost or the expense is fixed by making the premium on account of whatever you pay on the option contract. If you are a buyer for an option contract, it is fixed. In the case of futures, in the case of interest rate swap, it is not so. Are you able to identify the difference between these two? Interest rate swap can make you end up paying more interest than what was originally. So my question is, can it be treated as an hedging instrument because you are not protected against the risk all the time, only 50% of the time? Is the question clear to you? What is the answer? So can this interest rate swap be treated as a hedging instrument or not? Obviously, the answer is, unfortunately, the answer is yes. I'll tell you why. Okay. So the reason is, see, if you are looking at minimizing the risk, we are looking at this at an enterprise-wide level, not at the instrument level. Okay. Now let us assume, what do you mean by minimizing the risk? Minimizing the risk means you are adhering to the risk management strategy of the enterprise. There is a risk management strategy laid down. Who has laid down? The Chief Risk Officer has laid down the principles. What does the principle say? This principle states that I can have a fixed rate exposure of only 60%. 60% of my total exposure can be in fixed rate. That is the limit. I can't come up with a fixed rate more than that. That is the risk management objective. You already have an exposure of 1000 crores. Out of 1000 crores, assume you already have 600 crores exposure as fixed rates at various time points. You want to come up with another 100 crores at fixed rate. So you are not conforming to the risk management objective, right? Are you with me? You are not allowed. So what do? You still go with the exposure, the exposure, but you take an interest rate swap. The objective of the interest rate swap is what? Is not to make profit or is not to minimize, but objective is to ensure that you are complying with the risk management objective of the enterprise. Because in that case, what will happen? There will be 1100 crores will be the exposure after this, out of which only 600 crores will be fixed rate. The remaining 500 will be floating, because 400 was already floating. This will be also treated as floating because you are actually going to end up paying only floating rate. Are you with me? So it is not the question of finding out whether this particular instrument is enabling you to reduce the interest, but it is the question of finding out whether this instrument has made you to conform to the risk management strategy of the enterprise. Is it clear? So interest rate swap, in spite of the fact that there can be only 50% of the time, obviously 50% of the time it will become, you will be better off. 50% of the time you will be worse off. You will be better off not taking the instrument. In spite of that, it can be treated as a hedging instrument. Okay. Now what happens? So in this example, if the interest rate swap is terminated, then you will go back to measuring the fixed rate exposure on an amortized cost basis, which means now comes the question. So now the value of your liability as on the date on which it got terminated, the interest rate got terminated, was how much? What is the value? 100 plus 12.99, right? 112.99 will be the value of your debt security as on the date on which, right? From 112, what is the maturity value? 100 crores. So from 112, you will amortize it to the extent of 100 crores. Okay. Now, this EIR, we talked about this EIR, which is the effective interest rate. Effective interest rate is something that is cast in stone. Once at the time of inception, whatever effective interest rate is there, it never ever undergoes a change. There is only one exception to this rule provided in the standard, and that is on account of the fixed rate exposure after the discontinuation of a hedge accounting relating to covering the interest rate risk on a fair value hedge. So this is exactly the situation. So here we have a fair value hedge and we are discontinuing the fair value hedge. So my original interest rate will now undergo a change, because now my effective interest rate will be calculated from not based on the 8%, which is the fixed rate here, not based on 8%, but instead it will be based on 112.99 has to be amortized to 100 crores. So that will be the revised EIR. Okay. So the only exception provided in the standard is the example that is given here as well. Okay. 112.99 amortizes to, that will go on. Now this will be 112 becomes 100 crores, right? So to that extent, it will get amortized on a reducing balance method, on effective interest rate method.
Also do in foreign currency exposure. Loan is in foreign currency. If there is fluctuation, we adjust EIR at the every reporting period.
No. If it is foreign currency loan, if it is hedged, okay, if the foreign currency loan is hedged, unhedged you have to do you have to only do a fair value, right? You have to report it at a fair value. So which means you have to mark it based on the current value, current FX rate. You have to restate the liability. It will be treated in the P&L. That's it. Clear? Okay. Now this is the fair value hedge. So in a fair value hedge, let me summarize this. In a fair value hedge, both the hedged item and the hedging instrument. So in this case, the debt security and the interest rate swap both will be valued on a fair value basis. Both will be valued on a fair value basis so long as the relationship exists, and both will be transferred. The fair value changes will be transferred to the P&L. Okay. Now, previously, this hedge accounting was an accounting jugglery. In IAS 39, it was more an accounting jugglery. But in IFRS 9, it is not so. In Ind AS 109, it is not an accounting jugglery because it is very, very tightly dovetailed into the risk management objective of the enterprise. That's what I explained to you right now. So, in IAS 39, you had the choice to start and stop anytime. Here it is not. You have the choice to start, but you don't have a choice to stop. You can't stop voluntarily. It has to be based on. So whereas if the risk management objective is not adhered to, it has to be stopped. So the corollary is that it has to be discontinued if the risk management objective is not fulfilled. Okay. I think we are left with only 20 minutes. I will give a bird's eye view of ECL. Otherwise, we are not doing justice. I will do that ECL. Now, this ECL, I'm not going to use this. I'll explain to you. See, the ECL, expected credit loss, as I started in the introduction, the model is slightly different from what is used in US GAAP. Okay, there is, because they agree to disagree. So there is some slight differences there. We don't have to worry much about it because we are not doing under US GAAP. Now under IFRS, that is Ind AS 109, it is completely principle based. Okay, so that means everybody can follow whatever they think is correct. So there is no right or wrong answer here. Okay, that is good and bad. That is good because you can have your own interpretation. It is bad because you can't compare with another company. You can't find out. So two companies in the same line of business, right, in the same activity, you can't compare. One will be showing a different ECL, another can show a completely different ECL as a percentage because the models can be different. Now, so what is so good about the model? The model has got to be completely transparent. It has to be transparent. You can't say, these are all the parameters that go into the model, put it this, and this is what comes out. Don't ask me how it came out. So something is happening in this. That's a black box approach. That is not accepted. So it has to be completely transparent. See, I'm telling you this transparent because there are some models, like for example, I don't know how many of you are aware, there is something called as XG boost. XG boost is a mechanism where the model learns by itself. See, supposing I am a bank, okay, and I capture about say 20 variables at the time of giving the loan, some 20 variables about the individual, about the borrower. Then at the time of the valuation, I find out the same 20 parameters how it is. Then based on that, there is a methodology called XG boost, the implementation of which is available in Python, R, everywhere it is available, where based on these inputs, it's a self-learning model. It learn by itself. That is why it's called XG boost. Learn by itself, and then it will give you a prediction how many of this can go wrong. That is, how many of this can become defaulted. If given these parameters initially, how many of this will become defaulted. Now there is a huge accuracy levels. It is close to 90, upwards of 96% accuracy level. 96 to 100% is the accuracy level for this model called XG boost. So can someone use this XG boost for ECL? No, this has been debated now. Few of my clients, we have had a lot of debates on this. XG boost is used by HSBC in UK, but I have not seen any XG boost that is deployed in India so far. Okay, because it's more like a black box approach, because there is so much of statistical things that goes inside the computation. So you put these parameters, you take this out. Okay, why I'm saying that is, whatever model that you follow, it has got to be completely transparent. Okay, you don't have to be a Nobel laureate or a PhD in order to devise this model. Simple common sense approach is enough. What they are looking for is basic common sense, and that has to be followed consistently, because whenever there is a change in the model, okay, it is viewed as a sort of a profit smoothing exercise. Whenever there is change, right? So you can calibrate the model. It doesn't mean that once you start with a model, you have to stick with it for life. It is not like that. You can always calibrate. You can even change the model, but it has got to be based on certain sound reasons. Like for example, when they started, there could be some set of data that was available in the bank, and subsequently, there are other details data that is available. Based on that, you can always calibrate. Okay, so calibrating the model is continuous exercise. You can even change the model once, but it can't be a routine. Every quarter I will change the model. No, that's not accepted, right? Because it will be treated as a profit smoothing exercise. Now, the ECL has to be done at every period. So the broad guidelines that are given are, it has to be computed for all the assets, financial assets. Every financial asset it has got to be. Okay, so good asset, bad asset, normal asset, standard asset, whatever terminology you call, it has to be applied, right? And there is, if the credit risk increases significantly, then it goes to level 2 or stage 2. First is stage 1. Stage 1, normal assets. Every asset will undergo stage 1. If the credit risk increases significantly, then it will be treated as stage 2. Now, when does it increase significantly? There is a lot of debate on this. When does it increase significantly? But by and large, if the credit rating goes down by 2 notches, it means that credit risk has increased significantly. So a lot of yardsticks, a lot of examples or illustrations are given in the standard. But those examples, it might be, a lot of interpretations are involved in these examples. Okay, so they have given a rebuttable presumption that if it exceeds 30 days, days past due, DPD exceeds 30 days, it is treated as stage 2. That is, it is treated as if significant increase in credit risk has occurred. It's a rebuttable presumption. So which means, even if there is a DPD of 45 days, you can still argue that this particular instrument, this particular borrower, credit risk has not increased significantly for reasons that are known to you. You can always repudiate. You can always rebut that presumption. So when it goes to stage 2, you have to provide for the lifetime losses. Okay. By and large, the formula that is used, which everybody will say, is probability of default multiplied by loss given default, multiplied by exposure at default, multiplied by the discount factor, because the time value of money has also got to be adjusted. Okay, these are the broad things. But then this particular formula, PD into LGD into EAD into discount factor, is not given anywhere in the standard. This formula is not given anywhere in the standard. Okay, this is given in Basel, it is given, but not in IFRS. Okay, not in the standard. But then when you try to implement the methodology that is given in the standard, it boils down to this, PD into LGD into this thing. But it is not given in so many words. So ECL is, in a nutshell, it is the present value of all the cash shortfalls. What is the cash shortfall? Cash shortfall is the difference between the contractual amount that you have to receive and the expected amount that you are now expecting. So whenever the expectations of the contractual cash flows goes for a toss, obviously there will be ECL. So the way ECL is defined is, it is the present value of the cash shortfalls occurring on the instrument, which is, cash shortfalls is the difference between the contractual cash flows and the expected cash flows. That's it. Okay. Now, so what is probability of default? So you can find the probability of default by very many means. Okay, you can do it based on the historical data, basically historical data. So you find out how many are defaulting after 1 year. So today the number of loans, or say in 2000 Jan 2020, the number of loans are 1 lakh, and in Jan 2021, 9,000 out of that is defaulted. That is, it has gone to more than 90 days. Then 9,000 divided by 1 lakh will be the percentage of default. So find out the percentage of default on a rolling basis and take the average of that. That is one simple straightforward method which is staring at you black and white, right? Because nobody can dispute it, nobody can deny it, because anybody can take the calculator and compute it. So that is one method. The other method is what is called as transition matrix method. So you find out how it has moved from 1 month to the other month. So in this month, in which bucket it is, the next month in which bucket it has got to. Find out that on a loan by loan basis for the last 50 or 60 months, and then aggregate all that and find out the percentage. That will give you what is called as a transition matrix. Now, this transition matrix is highly superior to the historical method, because here we are actually taking into account what is called as a curing effect. The curing effect means somebody becomes defaulted. Okay, that means they move to greater than 90 days, and then they also pay a lot of installments and they come back to normal. So that is what is called as a curing effect. So the curing effect is automatically taken care of in this transition matrix method. Okay, this is another method. Now, if you follow one method, you have to consistently follow that. You can't say, I will move from transition matrix to historical and historical to, I will keep oscillating every month. No, that's not possible. You have to stick to it. Then there are two other major requirements in the standard. One is you have to adjust this, whatever you get here, historical or transition matrix, it is always called as the long-term average. It's the long-term average. So take that as the yardstick, as the basis, but then you have to adjust it for the macroeconomic data, future macroeconomic data. Now, this data is provided by very many agencies like Bloomberg or Economist Intelligence Unit. Most of these are paid sources. You can get the data from them. They provide about 300 different macroeconomic variables. You pick and choose the ones which are relevant for your industry and confine it to say 10 or 15 data, 10 or 15 macroeconomic factors. And then based on that, there is a Vasicek, there is a formula called Vasicek formula. Use that Vasicek formula to figure out the forecasted macroeconomic factors, to figure out the forecasted defaults, forecasted probability of defaults. Now, what should be the criteria that should be used to filter those macroeconomic factors? I have 20. Now, you need to find out whether there is any relationship between the macroeconomic variable in the past with my default data, right? How will you find out? You can run a simple correlation analysis. So, if the GDP goes up, your default should come down. Obviously, it has to be there. At least there should be a negative correlation of 0.5, right? So less than, it should be minus 0.5 or less. Then it means that there is, if my GDP goes up, my default also goes up. What does it mean? It's counterintuitive, right? It is not, it has to be rejected, right? So in many cases, in many companies, I have seen that that's what happens. Default goes up, GDP goes up, default also goes up. I don't know what is the reason. But then in that case, we can't rely on that, right? So if the default goes up, their PD also will go up and they will show more ECL. So that has got to be rejected. Then you can do one small adjustment there. Like if the GDP goes up today, it will put more money in the hands of the people. It's supposed to put more money in the hands of the people, right? Eventually, but it may take 1 year. Today, my GDP has gone to from 8%, it has become 9%. So overnight, tomorrow everybody won't have that much money, right? It will take 1 year. So adjust it by 1 year. So move the data by 1 year and then find out the correlation. Now, whatever was showing a wrong or counterintuitive correlation, now will become intuitive. It will show a right number. So that sort of a thing has also happened. So find out whichever is passing. Take only those factors and then use it in a Vasicek. See, these macroeconomic variables are super sensitive. Okay, so if you take a wrong macroeconomic factor and you try to work out the ECL, you will get some absurd results, totally absurd results. Sometimes, in my experience, I have seen even the data provided by this paid source, in the month of March, they show something. In the month of April, they provide every month. The month of April, for the same factor, completely different. So, I mean, those are aberrations, but those are outliers or whatever. Those things also happen. So we have got to, ultimately what happens, we have to apply our common sense, right? So we can't simply go by, okay, this is the data, this is my formula, don't ask me why, this is the number that you can't, you have to apply your mind all the time. You have to apply your common sense and then say, okay, I have to reject this, right? So there are three things, no? Lie, super lie and statistics, right? This is so you have to be very careful with handling statistics. So you have to be very careful. Okay. Then the LGD, as far as loss given default is concerned, there are two ways by which you can do the LGD. One is called as the futuristic method. You know, futuristic method means you have the value of the collaterals and apply a discount factor on that. Not the discount factor. Sorry, apply a haircut on that. And supposing it is land and building, for example, it may take 5 years for you to realize, because SURFACE, all those IBC, so many formalities will be there. It may take 5 years for you to realize. So you have to discount it, the value of the collateral to the present value. That is what is realizable today, right? And then find out what is the loss, apply it as a percentage. So that is the recovery amount. So 1 minus recovery amount will be your LGD. Take that LGD, like this is what is called as a futuristic LGD. Now there is also one thing called historical LGD. So historically, what is the actual loss suffered by me? Means take those cases which got completely cleared, take the loans which got completely cleared before the valuation date, and find out when it got first defaulted and what date it got first defaulted. Find out the principal outstanding as on the date or the exposure as on the date, and find out what is the cash that is collected subsequently, discount all the cashes back to that date, and find out what is the loss. So this is what is called as a historical. So these two methods you can use the historical way. And finally, the exposure itself. Exposure, we know exposure consists of your actual principal outstanding plus if there is any interest that is not yet collected, that also should be added along with the exposure. There is a total exposure. So we have the PD, we have LGD, we have the exposure. You can multiply all that and take that as the ECL. Okay. Now there is when you do the forward-looking information, you should also agitate the PD in the sense that it goes up and down. So you will have at least 3 scenarios. What the standard says is a range of scenarios. Range of scenario doesn't mean 100 scenarios. It doesn't mean that. Minimum of 3 should be okay. So take 3 scenarios and take the weighted average of these 3 scenarios, and that will be your final outcome. Okay. I mean, in 20 minutes, this is what I can summarize for ECL. Normally ECL will take about 3 to 4 hours to each aspect of it, but I thought this is a bird. Trade, so okay, see, trade receivables, ECL on trade receivables is something that is most neglected. Okay, now there is a beautiful publication given by NAFRA. It was published yesterday. Okay, there they have mentioned how this has to be taken. What are the things that has to be taken, not only for the for ECL in general, including trade receivables and other contract assets and all those stuff. Okay, lease receivables, etc. Now trade receivables, normally what they do, they make sort of a provision matrix, right? So previously that is how we used to do. So based on the aging, so less than 30 days, 0.25, 30 to less than 6 months, 30 to 6 months, it is 0.75, greater than 6 months. So that is not acceptable now. Okay, that's totally not acceptable. It has to be based on the historical performance. So you have to do the historical performance, and that also has to be adjusted for the future. Now, there's one small, clarification. Many people ask me. See, in the case of trade receivables, you have to apply what is called as a lifetime default. The method is simplified method. In simplified method, you take lifetime default. So actually simplified is more complex. Okay, that is different story. Simplified approach is actually more complex than the regular method. But in simplified approach, the reason why they are saying lifetime default is because trade receivable itself is very short duration, 6 months to maximum 1 year normally. Okay, there are EPC industries, etc., where it spans over for 8 years, 10 years. That's an exception to the rule. But normally it is less than 1 year, right? So less than 1 year, there is no point in having a 1 year default and lifetime default. So that is why they said that for this one, everything is lifetime default only. So there are the method that is usually followed in the case of trade receivables is we take the aging for the last 60 months, take the aging and find out the flow rate. Based on the flow rate, find out the roll rate and the loss rate and apply that. That is what is normally used. So here in this case, we take the value of the receivables, right? Not the numbers, the value. Whereas in the case of ECL for loan portfolio, it is the numbers that is taken and not the value. Okay, there is a very significant difference between these two. And so trade receivables often neglected, right? And NAFRA is coming on this very severely. So we need to ensure that for trade receivables also proper ECL is computed. I mean, there has got to be a scientific system. Again, there has got to be a proper system. That's more important than the accuracy level or the model or the approach or whatever. That can be different. There can be differences can be there because once there is an approach and so long as you follow the approach consistently, there should not be a problem. Because then there is no doubt that you're doing this for profit smoothing or anything. That's all the only thing. Any questions?
The ECL is given in 109 or
109, 109.
You said it is not compulsory to have get into this specific. The PD is something like that. The formula is not given.
It is not given, but it is ultimately it's the principle. If you apply the
Finance annual report, big paragraph, big calculations given. Anybody will understand that?
No, somebody who.
And another thing I want to say. Every year that loss is going up and down. How they run the business? Why they give so much loan? Why they increase the
Good question. Asked to the wrong person.
I am seeing this.
The good question. The management is the right person to ask.
Paragraph is going up, the numbers are going up, and they run the business also.
Good question, sir. Wrong question, wrong person. It should be addressed to the management, whichever company. I don't know which company. Or I don't want to say that. And also on FVOCA instruments, not on FETPL, only on FVOCA.
Or in other words, to alert the investors, it is given, sir. LFS, they would have assessed, they would put the valuation, given the number. But nobody read the balance sheet and annual report, and one day they close the business. And the promoters are in London.
Correct. Yeah, to avoid all that only we are doing all this, no? Somebody has to read, somebody has to say.
Just like if the report is some 500 pages, 600 pages, who will be interested to read those things? That is, in order not to read by the investor only, they are making the report 500, 600 pages.
Sir,
This is what I hear from general public, not from chartered accountants.
Sir, we have to be expert in ECL, sir. We are expected to be an expert in ECL.
No.
Suppose auditors are not.
That is why, so there are some experts who do only this job. No, we can't expect. We can't go and perform heart surgery. No, you have to call a doctor who can perform heart surgery, right? Correct. No. Any other questions? The auditors ask question whether it is an external consultant or it is done internally. Okay. Whether it is done internally, the auditors ask all these questions. Whatever you said, no, they ask all these questions. In fact, if you go through the publication given by NAFRA yesterday, they have released. Okay, there they have mentioned these are all the questions that the auditors have to put forth to the board, to the audit committee. Okay, so exactly all these questions. See, it's all done there, recorded, everything, audit evidence. So, see, we can't have the public privy to all these things. No, it's not possible. That's beyond the scope of this topic, general topic.
Generally, so this issue is therefore not beyond the issue.
Thank you, sir, for your wonderful session. So we'll break for lunch and reassemble at 2. Lunch is served opposite. Thank you. Next technical session. So we have Udupi Vikram. Please. So I would request CA Sridhar to present a memento to Vikram. So, brief introduction about Udupi Vikram. Vikram is a partner in Suresh & Co., a firm of chartered accountants which is in practice for the past 55 years. He brings in a rich experience and expertise with proficiency in finance. Through a professional career spanning more than 14 years, he has led various prestigious assurance and advisory engagements from some large and Markway clients in IT and ITES, financial services, manufacturing, textile, retail, education and real estate sectors. He brings in a demonstrated history of working in the audit and assurance industries. His areas of specialization include startup advisory, family offices, Ind AS, IFRS, US GAAP, risk management, internal control, statutory audit, corporate advisory restructuring. He has worked extensively with multinational corporations and Indian groups. He is an experienced auditor with extensive experience of reporting to board, audit committees and interacting with the senior management. Over to you, Mr. Vikram.
Good afternoon all. So the session is about auditor's report or CARO coupled with couple of other reporting things. Morning 2 sessions we heard 2 people talking about various factors in audit. There was one comment about how NAFRA is commenting on certain things, how NAFRA is giving advice on various factors, and Mohan sir spoke about various IFRS which is there, the standards which is coming up, the different evolution which is happening, rather IFRS 18 coming and replacing schedule 3. So all these things, the first thing who will get affected is obviously the auditor. And if I see our own life, our own firm from last 3-4 years, one of the basic things everyone is telling is it is easy to clear chart accountancy, but it is difficult to sign an auditor report. So that's one of the things which everyone telling, and majority of them also tells I'm good for advisory, I don't want to get into independent auditor role. So why all these things are coming up? Obviously one of the major reasons people are concerned about signing the financial statement is NFRA. Plus now with the latest amendments, peer review has been made mandatory for other firms also where partners are more than 3 and similar to that. So everywhere, end of the day, what comes into picture is what kind of audit the audit firm has done, what kind of documentation the audit firm has, and how partner has gone ahead and signed the financial statement. So when we talk about each of the audit or each of any of the assignment, the final thing which matters is the report or a certificate or an opinion an auditor gives. Thankfully our institute has come up with various exposure drafts or guidance notes or practical guidance which helps us to understand how should we report, how should we take up an assignment, and how should we perform our audit procedures. So in one of the sessions our MP Vijay Kumar sir had made a beautiful comment which is always running in my mind. So the comment what he told was, as auditor we have one of the greatest tools with us, which is auditor report. The financial statements belongs to the company. Company designs an accounting policy, company designs an accounting methodology, and they disclose it. Stakeholders depend on auditors to take various calls, and it is we as auditors, we have this tool called auditor report where we can represent or we can put across what exactly we have seen. If there are any comments which we need to give, auditor report is one place where we can put our comments. For example, unless an auditor comments about, we also spoke about expected credit loss in the morning. As an auditor, it's again an important thing to comment how expected credit loss has been taken care or not. It may be part of key audit matter, or it may be part of certain other stuff. Once we give our report, there is an impact on the stakeholders and various things can happen. Imagine a scenario where again there was one comment on one of the bankers telling there is so much of expected credit loss which they are disclosing, it is increasing year on year. So why an auditor plays an important role here is, unless the auditor gives his comment, there may be a scenario the good money will follow the bad money. Like end of the day, who pays is the common man, and he ends up taking the pressure of the bad money. So keeping that in mind, we will be discussing about the important aspects of reportings what as an auditor we do, and of course a bigger picture will be on the CARO 2020. So what are the reporting requirements? The basic reporting requirement which we have been learning from our foundation period or from our BCom, it is true and fairness. Compliance with accounting standards is another important thing where we talk about. Accounting standards could be Ind AS or AS, maybe other than Ind AS and AS, we also, whenever we talk about 44AB in income tax, we speak about ICDS. Financial controls, the most important thing, the internal financial controls, wherever the entity is liable for internal financial controls. As auditors, we need to comment on IFC. Fraud reporting, if the fraud has happened, it's reported for more than 1 crore, it is our responsibility to report to the central government. Disqualification of director is another important aspect where as an auditor we comment in the auditor reports. LODR, the listing requirements. LODR has various aspects where as an auditor they have to comment on the listed companies. Key audit matters, especially key audit matters are not any modifications. In key audit matters, as an auditor we try to comment how an audit procedure was done on certain important aspects of the financial statement, maybe where assumptions are involved or some sort of estimations were involved. Then CARO is CARO 2020, which has 21 clauses. We will be going each line by line over there. As I mentioned, auditor report is a tool for auditor. Stakeholders' interest and value of the society is involved. Mitigation of liability. So end of the day, once we share our auditor report, once it goes to the third parties, we will not be able to do anything on that. Tomorrow, if at all there is any question from any of the regulators, the only documentation which helps us is how we arrived at our auditor report, what kind of documentation we had and what kind of supportings we had to say about auditor report. Value addition to client, many times it happens when we do audit, we come across certain basic and also the complex features in a company. We will get to understand their business structure, we will get to understand their methodologies of accounting, we will get to understand the kind of internal controls which they have. So that's one of the ways in which we can add value to the client. Demonstration of diligence and professional confidence. By reading an auditor report, we can actually tell whether the financial statement has been audited properly or not. We come across various kinds of auditor report where some sort of errors, for example, the auditor report will talk about consolidation where there is no subsidiary. Auditor report speaks about IFC where IFC is not applicable. Auditor report speaks about dividend where dividend is not even been declared. So those kind of things will actually affect the kind of quality we are talking about, and also it affects our image outside. Introduction to CARO 2020. CARO 2020 is basically company's auditor report order, which was issued by MCA using it was issued under section 143(11), which gives the power for MCA to central government to issue the same. CARO 2020 has got lot of interconnection with Schedule 3. Until Schedule 3 got amended, it was more about responsibility of auditor to give his comments in the auditor report. But thanks to Schedule 3 which got amended, there are various elements where we report under CARO which has to be disclosed again by the financial statement, by the management in the financial statement. For example, there are certain comments which as an auditor we have to make in the auditor report, like utilization of funds. It may be about willful default, or it could be about internal financial controls and all. Similar fashions, these disclosures has to happen in Schedule 3 of the financial statement. Using the CARO also helps to give a transparency and accountability in the financial reporting. How we perform CARO review, or how we report CARO, is obviously based on the general approach. Whatever standards on audit we apply for doing the financial statement, same standards of audit applies for CARO also. It is not something where we need to go beyond what as an auditor what we are allowed to do or what we are expected to do. How it enhances transparency? We have mentioned CARO enhances transparency. How exactly it helps a stakeholder for getting a better transparency? One, detailed reporting requirements. If you see certain clauses where we talk about in CARO, we comment on utilization of loans, we comment on to what extent the company has been compliant with statutory and regulatory dues, to what extent the property records are available. We say title it is available or not. These kind of comments when we give in the CARO, it gives a better transparency. Imagine you have been seeing only the financial statement. You see 200 crore of plant and equipments. You see 100 crores of real estate available with the company. Of course, there are assertions. The moment we see the financials, we'll keep some assertions. The moment it is fixed asset, we say okay, there exists ownership. The moment we say fixed asset, we say there are rights and obligations with respect to that, or valuation with respect to that. But to what extent those assets are actually belonging to the company is something a stakeholder can get to know only through auditors, and that is where the CARO helps stakeholders to understand better. Compliance check, utilization of loans, the way guarantees are given, the way statutory dues are taken care, gives a better compliance check. Material disclosures, we talk about fixed assets verification, we talk about inventory verification, we talk about title deeds available, again this gives a material disclosure. Related party transactions, even though there are accounting standards, whether AS or Ind AS, which requires financial statements to disclose related parties, but as an additional feature, auditor comments about compliance with related parties. This is one of the biggest disclosures which happens through CARO, and stakeholders understand various types of transactions which they have, both direct and indirect. Finally, the controls. As in CARO we comment on fraud reporting, in CARO we comment on internal audit, NBFC guidelines. These are all additional things which we talk about controls. Companies which are not covered by the order, banking. Of course, in banking we see lot of other disclosures. There are 2-3 certificates which we comment. When it comes to internal controls, there is LFAR where we disclose each line item separately, so there it is not applicable. Insurance companies, they have their own. Section 8 company, which is basically not for profit, for whom CARO is per se not applicable. One person company and small company, CARO is not applicable. Private limited companies, unless their turnover is more than 10 crore, share capital reserves more than 1 crore, borrowings more than 1 crore. If that is not the case, then CARO is per se not applicable. One thing to be kept in mind for private limited companies, you need to see applicability of CARO every year. It is not one time. This year CARO may not be applicable, next year it may become applicable, or this year it is applicable, there's chances next year it may not be applicable. So now if we get into specific thing, property, plant and equipment. As we all know, whether it is a manufacturing company or a company which is an ITS company, the basic thing which will be there in manufacturing company could be plant. The biggest investment a company which does to earn revenue is through plant. First they invest on land, then they invest on manufacturing facility, then they invest on getting the plant inside the factory, etc. etc. So fixed assets makes a very important item in the financial statement. The weightage for fixed asset is pretty high. There are various ratios which we use to analyze the performance of company through fixed assets. It may be something about fixed asset turnover ratio. It may be something about how many products is being manufactured every second or every minute. So everything goes against what kind of fixed asset they have had and what is the obsolescence which is there. If I have to talk about ITES, the investment could be on technology, investment could be on intangible asset. Even intangible asset is part of the same clause, where in ITES they capitalize intangible asset. Subsequently, there may be some requirement to do impairment. So all those things will be covered under property, plant and equipment. In addition to this, under Ind AS, we have something called right of use asset, which is basically the lease, which is part of this particular clause. Investment property, the investment like under AS, we call it as AS 13, like wherever we have invested on the real estate which earns rent, which will be part of this. Non-current assets held for sale will also be considered here. So what is that we are talking about plant and equipment? What is, as an auditor, what we comment on PPE in CARO? The first and foremost thing what we comment is to what extent fixed asset register is maintained, or to what extent fixed assets are appropriately documented. So exactly what do we mean by that? There are 5-6 types of fixed assets available in a company. Let us take a manufacturing company. They may have something called land, they may have something called plant, they may have computers, furniture, fixtures, various stuff. When we see schedule 3, what we see is one particular note which tells what is the gross, opening, closing, WDV, opening, closing, and those stuff. So as an auditor, when we do the audit, we go deep dive, we look at the fixed asset register, we try to understand what sort of assets are there and how they have maintained it. Like couple of guidance which is there for PP is whether the location of assets are shown properly, whether the value of the assets are shown properly, whether the computation of depreciation is appropriately disclosed or not. Plus something which also important from last 2 years when it comes to property, plant or fixed asset register, majority of the times the tools what companies use, they, if at all they are using Tally or similar tools, fixed assets are generally maintained outside Tally. It may be in Excel, it may be in some other tools where trail is very important. If you maintain the data in Excel, it may not be possible for you to go and verify the trail, and because of that there could be certain chances that internal controls could have been modified. There could have been chances that some errors would have happened which may not get rectified, and those are things which we verify when it comes to either trail or CARO. Second thing which we comment in CARO for PP is whether the physical verification was done. If physical verification was done, whether it matched with the data which is available. Where the variance is there, we have shown the company has say 640 laptops against physically what is available may be more than 640 or less than 640. So to what extent is that reconciliation has been done, and are there any material impact? That is something which as an auditor we comment on there. Third most important thing is title deed. Can give an example when a government company where if you see in Karnataka we have something called ESCOMs and BESCOMs. They are electricity transmission companies, supply companies. So what we have understood when we went there and we tried checking all these details, we got to know there are so much of land which is disclosed in ESCOMs, but title deeds does not belong to them. The reason being, some 30 years, 40 years back, some main person in the particular village would have given his land to ESCOMs to make sure that there exist some power transmission companies, and they have been continuously using it. Similar way in private limited companies, many times it happens, the land could be in the name of director, but company is disclosing that as their assets. So these disclosures help the stakeholders to understand whether title deed exists in the name of company or not. Comparative, the other part, schedule 3 thankfully also requires financial statements to disclose whether property, plant and equipment's title deed exists in the name of the company, and that is what as auditors we are going to reconfirm. So how exactly PPE works? Whenever we as statutory auditors, when we go there, what are the challenges we face when we take up this particular clause? One, imagine a company which has 13-14 branches, and in each branch they have land or they have lease. Look at the kind of quantum of work which we need to do to obtain this documentation first and to analyze this documentation. It's a huge task. You need to have a proper system to document the title deeds and to connect the title deeds with the asset which is actually disclosed in the financial statements. So when this CARO came into picture, one of the first things which an auditor would have done, or what we would have done, is first identifying the fixed asset register and tracing those with the title deeds. The most important thing could be try to have these title deeds and data updated on an electronic mode, so that tomorrow if that all any changes happens, you have the data available with you and you can keep on updating it in a easier manner. Another challenge could be identifying discrepancy in case where records are poorly maintained. Majority of the private limited companies, the data is always a challenge, and when we go and ask something, they'll say the data is available in some place or the other place. So how exactly as an auditor we can get into this? We face the challenges. Determining whether expenses qualify for capitalization or should be charged to revenue. In a plant, when you are applying AS 10 or Ind AS 16, when you are building a new plant, there are various expenses which comes into picture. How should you treat those expenses at the time of construction process? That is again part of Ind AS, which we will be talking in CARO. Any expenses which is directly related towards bringing the plant into its existence has to be capitalized, and that is something which we need to check while we review the fixed asset registers. Ensuring appropriate allocation of costs such as borrowing costs or dismantling costs. Dismantling cost is again a concept. It's called asset retirement cost. If I have taken an asset on a lease and I am developing that asset infrastructure for my company's requirement, and it is for 5 years. At the end of 5 years, I need to leave the place and I have to go out. At that point in time, I should leave the asset in a way which was given to me. I would have taken as a core shell, I would have built infrastructure, so I should remove those infrastructure and leave the place. So that is called asset retirement cost. That asset retirement cost should be part of the fixed asset and amortized over the life, whether that has been considered or not. Next one could be impairment, one of the most complex things. Impairment generally comes in intangible assets. How intangible assets have been capitalized and have they been tested for impairment when there is an evidence. When it comes to intangible assets, WIP impairment testing is mandatory every period, whereas the other than WIP, you will do impairment test only when there is an evidence. Revaluation, there is a comment required in CARO where revaluation has happened. We need to comment who has done the revaluation and whether revaluation, if it is more than 10%, the impact of the same has to be disclosed. Leases, we explained. Disposal, verifying the authorization and documentation for disposals. Again, to give an example how it happens in ITS companies, they buy lot of computers and computers disposal is another big thing over there. There is something called e-wastage. What is the process involved? Who authorizes this e-wastage? How are the prices identified and whom is it sold? Those things also come into picture. So in overall, when it comes to property, plant and equipment, as an auditor, one thing we have to be careful is whether physical asset verification has happened, whether the fixed asset register is proper, whether the internal controls are strong enough to say fixed asset which is disclosed in the financial statement has enough data available within the company. Similar one, next one, if we come to the second clause where we comment on CARO is inventory. Like how fixed asset is very important for manufacturing company, Inventory is another important item which has a bigger weight in the financial statement. Inventory we may use for selling the product. Inventory we use for borrowing money. Inventory we also consider inventory for various ratios. Keeping that in mind, CARO has given a bigger importance for inventory reporting. As auditors, we have to comment whether inventory verification is happening on a periodic basis and whether it is strong enough for the company which is running. Second, when you do inventory verification, if the actual inventory value versus rather quantity versus what has been booked in the financials, if the variance is more than 10%, as an auditor we need to comment on the differences. One additional thing which has come in CARO 2020 is, if the company or entity has borrowed money in excess of 5 crore and it has given inventory as a security, and if there is a requirement to give quarterly reports about working capital and inventory, as an auditor we need to confirm the inventory data what has been shown to the bankers, is it matching with the inventory data which is available with the company. So to explain this, it may so happen many times when we do bank audits we see this. There will be some sort of documentation available with us. We raise a question and we get some additional evidence to say inventory was up to the mark, and because of that OD limit was fine. So in order to fix this, this clause has come in CARO where statutory auditors needs to comment that the data which was shown to the bankers are more or less equal to whatever data which is actually. In the sense, my actual inventory every quarter is 30 crore, my facility with the banker is 40 crore, I cannot increase my inventory to 40 crore to say facility is within the limit, rather the borrowing is within the limit. In every the way it works in banker is based on the inventory, the OD limit or CC limit may be identified. Challenges which an auditor face, of course, verifying inventory with third party location. Imagine a company has multiple job workers and company has sent items to job worker place. Those assets belong to us, belong to the company, and that verification has to happen. As an auditor, how do you design this verification is something which is very essential. Inability to conduct physical verification during disruptions. Everyone faced this. During COVID, we had challenges. How do we verify the inventory? Thankfully, Institute came up with certain guidelines, and also today the technology helps. Today what we do, if inventory is located outside the place where you are in, you can use some technology like there could be a certain thing, their team will do the verification and we check through Google Meet or Teams Meet or some sort of technology, using CCTV camera the verification can be done, or you will apply sampling method to go and check the basic things. So these kind of things has to be taken care. Ensuring management has adequately addressed and corrected discrepancies. For another important thing which happens in inventory is how inventory has been valued. Many times inventory is also considered to be, as Mohan sir was talking about, in cash flow there is a working capital adjustment. It is always a balancing figure. Many times it so as also happens that inventory is used as a balancing figure. Wherever the profits are fluctuating, people try to use inventory. Even though ICDS 2 talks about inventory valuation, even though AS 2 talks about inventory valuation. With this coming into picture, as auditors, we have a bigger risk and bigger responsibility to make sure inventory has been valued as per AS 2. The third one, which is again something which is very important, is loans and advances. If you see, majority of NFRA cases which has come up is basically about fund utilization, fund borrowings and transactions with related parties. So all these three items are generally connected whether the company is listed or unlisted. Because of this, CARO has given a clause which specifically talks about loans and advances, both the company which has lent or the company which has borrowed. Coming to the first thing, how you have to check what and all loans which has been lent. You need to see what is there on the asset side and how the money has been lent, whether they have complied with section 185 and 186 of the Companies Act. What is 185 of the Companies Act? It is a prohibiting section. No company can lend money to directors or the entity where directors are interested. 186 is a allowability section which tells if you comply with a specific percentage, you can invest or lend to the other company. So indirectly, it's a requirement for the auditor to check that section 185 and 186 is compliant, and if it is not compliant, we need to make a disclosure in the CARO. And second thing which is important as an auditor to comment is, if company has lent money, then what are the terms and conditions? Are those terms and conditions prejudicial to the interest of the company? Imagine I am borrowing money at some rate and I am lending money at a lower rate, or I am lending money to someone who has an interest in the company at a lower rate. I am lending money to someone which is not able to give me the minimum IRR which I would have earned if I had used the money in the own company. When it comes to loan, another important thing is AS 18, the related party disclosure. Whom has the company lent the money to? Are they related to the company? If they are related to the company, is it appropriately disclosed by the company in the financial statements? Plus, under LODR, it is required that we provide additional disclosures, and if at all there are certain concerns in the related party transaction, which has to be specifically disclosed on the financial statements and of course in the auditor's report. When it comes to loan, there is one more clause wherein as an auditor we need to comment if the loan is lent and interest is outstanding for more than 90 days. Like how in bank there is a comment where interest is outstanding for more than X number of days, that goes towards a bad position. The same way as an auditor in the regular companies, we need to say if the dues are outstanding for more than 90 days, what are the reasons for which it is outstanding for more than 90 days, and what kind of action has been taken care by the company to make sure such money has been recovered, or action has been taken to say it will be recovered in the future. Challenges to the auditors in loans and advances. Imagine a scenario where company has lent money to subsidiaries and subsidiaries would have used it for some other reason. If I am not the statutory auditor of a subsidiary, it will be a very big challenge for us to understand how the subsidiary company has utilized the funds. We will depend on someone else, and as an auditor, we have to depend on component auditor, have enough audit procedures or questions from the component auditor to see to it that there is no non-compliance in terms of the money which has been lent. Section 186, law says interest has to be levied. The question could be, what is that interest rate which is not prejudicial to the company? So the only way to again cross check is go back to section 186 where they talk about government yield rate. Understand how the government yield rate works, and as long as interest is more or less equal to the government yield rate, maybe you are comfortable. Reviewing loan agreement and guarantee documents, one of the most toughest jobs. Loan agreement will have hundreds of terms and clauses. As an auditor, to what extent will be able to understand those complex documentation is something which is important. The people who work on this particular loan analysis, better to have a technical team which understands the complexities of the financial instruments, then accordingly reporting can be done. Evaluating the credit worthiness of borrowers, again, the one of the clauses which is required to be mentioned in CARO is these loans are not prejudicial, rather terms are not prejudicial to the interest of the company. So again, one of the things could be credit worthiness. How do you demonstrate credit worthiness of your related parties? How do you demonstrate credit worthiness of the entities where you have invested? Again, go back to your basics. Look at, you have to understand the terms and condition. You need to understand the financial status of the borrowers, to what extent securities have been given to you, to what extent repayment terms have been defined, whether those repayment terms have been taken care or not. This is the audit procedures which can be done to say it is fine. Imagine a scenario where a company has given guarantee to the other entity, and that other entity is using this guarantee for anything other than business operations. So, once guarantee is given, many times the control will not be in your hand. It has gone back to someone, and if he does any mistake, you will become responsible for making those payments. That is again a challenge which should to be taken care. Loans borrowed, as I mentioned, once the company borrows money, it is also important for an auditor to comment for what purpose the loan was borrowed and whether it has been used for the purposes for it is borrowed. Today we have a regulation called RERA, where it specifically says if money is collected, how should it be used. On the other hand, you just look at manufacturing companies, or you look at companies which borrows multiple loan. How do you demonstrate the reason for which the fund has been received has been used for the same purposes? So most important thing when it happens with cash is, we say cash is fungible. From whichever source it comes, it is difficult for us to track whether it has been used for the same purposes or not. But as an auditor, we are required to comment whether funds have been utilized for the purposes for which it was borrowed. So the methodologies in which it can be adopted is having a fund flow, having a fund flow statement, analyzing the way the account which has been used, analyzing the transactions which has happened, identifying the kind of vendors who are there in the organization, and all those vendors usually interacted for the operations of the company. Additional procedures can be performed, and you can have documentation to say loan have been used for the purpose it has been borrowed. Few cases which is easier is if the loan is borrowed as a term loan. For example, if I have to buy a machine, then the payment can happen directly to the vendors of the machine. That is easier. The challenge could be when funds are borrowed as a working capital. It just comes to my account. From there it goes wherever it can be. Few cases escrow will come into picture. Wherever escrow is there, our life is simple. Wherever there are separate accounts, for example ECB, when ECB comes to India, I have to make sure a separate account is opened, and from there the utilization happens. It will be easier for us to comment. If there is any reschedulement of the loan, as on the due date there was a requirement to make the payment, and just before the due date there is a reschedulement, as an auditor we need to comment, are there any background behind this? Is there any negative issue because of this reschedulement? Does it affect the going concern of the company? Is there any concern about the securities which has been given? Does it have any impact on the financial ratios of the company? Something which we need to comment on. Willful defaulter is one concept which has come from Schedule 3 amendment. Willful defaulter is basically an entity which has been identified by the lender, telling the lender has been blacklisted. So as an auditor, it's our responsibility to comment whether company is identified as a willful defaulter. Now the challenges here could be, where do we get this information from? When we do companies, say 30-40 companies when we sign, each of those companies may have multiple lenders. Each of the companies may have same lenders, multiple branches. Majority of them may not even respond to our confirmations, request for confirmations. So how do you identify whether the company has been identified as willful defaulter or not? It's again one of the biggest risks. So few options which are available. One, there are various tools available in the market which works on the database which is available, and they have they get the data from the bankers and they keep the record of willful defaulters. Maybe you can access those and get the information. The second thing could be, of course, CIBIL is one major source where you can gather information about entities which may be considered to be willful defaulter. And third most important thing is no other option but to make sure you seek the balance confirmation. Whenever you seek balance confirmation, have a specific comment telling is the company identified as a willful defaulter. Of course, company has to disclose in the financial statement. Auditor also have to comment on it. Few challenges an auditor may face. Wherever the company may hide issues, wherever they find there are issues with the lender, they may hide it, disclosing it from you. And because of this, you may not come across to identify a scenario where it could have been a willful defaulter. Tracking and verifying companies' compliance across all lenders. Imagine again a manufacturing company which has 3 or 4 plants. They'll be working with at least 3 to 4 bankers in each plant, and with that it will be around at least 12 to 13 bankers. Getting the information about all these bankers at one place and seeking confirmation, obtaining data about willful defaulter is again one of the biggest challenges. Guarantee, again, the company has given guarantee to a party and that party has gone bad. Because of that issue, can the company be considered as a willful defaulter? Again, this is something as an auditor you need to verify when you do the audit. Another things which we come across while we doing the audit, we seek data from the banker, and the data may be either old data or the data which is not updated. Many of the times even we have seen, we seek the data as on 31st March, but what we get may be 20th or 21st March. So this documentation needs to be appropriately verified and make sure the documentation what we have is complete and it is as on the period. End use of borrowing, as I mentioned, for every company as an auditor, we need to confirm whether the borrowing has been used for the purpose it is lent. In addition to this, nowadays banker also asks a certificate from the auditor. We need to give the certificate telling the purpose for which it has been received has been utilized or not. Plus, what happens in majority of the startups today, they have something called shareholder agreement. In shareholder agreement, they say for what purposes the money has been given and it has to be used for only that purpose. Or if you go and check, and also the another regulator where they say utilization of funds is FC, foreign contribution. Imagine you are working for an NPO and NPO gets money from abroad. There are certain restrictions for what purposes it can be used. You cannot use these funds for more than 40% of the funds cannot be used for overheads. So like that, there are various regulations which are applicable, and the only way you can answer this is if the internal controls and financial systems are pretty strong on it. Temporary usage of during construction period, there may be a scenario you borrowed money and you didn't have any requirement to make the payment to vendor, you have kept it aside, which is fine. That will not become a case where it has not been used for the purposes which it was borrowed for. Loan received during the year end and which is not used, kept on a bank or any other purpose, again it need not to be commented on a negative mode. General funds, I explained, it's one of the most difficult things. All diversions needs to be reported. So how basically the reporting happens? We say the money was borrowed for the purposes of building plant, but it has been used for making certain other payments. This kind of disclosure has to happen in the auditor report. Few evidences which may give you idea to say whether the funds have been used appropriately or not. One of the other disclosures which we have to make in CARO is whether a company which borrowed money as a short-term borrowing, but it has used for long-term purposes. It's again another important thing. The reason is very simple. If I borrow money for a short term period, I am obligated to pay it immediately or pay whenever they ask. Pay whenever there is a requirement from the lender. Assuming I have gone and invested this money in a long term investment, I would have invested on plant, or if I have invested on some other entity, then I will not have the liquidity to make this payment. If I don't have the liquidity to make this payment, I may go bad on that, and that is the reason it is prohibited that short term borrowings cannot be used for any long term investments. As an auditor, we need to comment on the same. Whether the company has taken any funds from any entity or person on account of or to meet obligation of its subsidiary, associates or joint ventures. Again, a comment which came from CARO 2020. For the purposes, for the requirements of meeting the obligations of subsidiary, I am borrowing money. So the whole thing here is I am dependent on someone else effectiveness if I have to make the if I have to repay the loan. How do we get to know about all these things? Identify all the new loans which has been borrowed during the year. Review all the transactions with the related parties. To check the transaction with related parties, most important thing, you have to have a strong list of related parties. You need to go through all MBPs. You need to go through the resolutions which have been passed and keep a matrix for related parties and see are there any transactions with these related parties. If there are any transactions with these related parties, go deep dive and understand why the transaction has happened. Is it looking more like a lending or looking like an investment for those entities? There may be a scenario where the company has lent money to subsidiary or it has used the money for the requirement of subsidiary. That doesn't mean there is a negative factor. You need to, when you draw the fund flow, when you make the fund flow, if you realize from operations you have enough money, the revenue from, or rather cash flow from operations, if it is positive, there could be an evidence to say the borrowed money is not used for someone else's purposes. Borrowed money is used for your own purpose, but the revenue from your operations could have been given for your subsidiaries or related parties. That way it is allowed. You don't have to comment anything on the CARO. IPO, wherever there is an IPO, we know that both from LODR side and from CARO side, as an auditor, we need to comment whether it has been used for the purpose for which it was taken for. Whenever you go for an IPO, you do something called DRHP, then you follow it up with RHP, and you specifically mention for what purposes money has been asked for, sought for. So as an auditor, in LODR, you have to give a certificate. You will mention how much money was taken and how much is used and how much is kept in the bank. Similar way, in CARO, you need to mention for the purposes for which it has been taken has been used or not. The other one is private or preferential allotment. Private allotment, why it is important, you will, through the SF4 you will get to know for a specific reason you have taken the money, and whenever there is private allotment, there will be some sort of prospectus which tells for what purposes you are taking the money, and you have to make sure that purpose has been taken care. Challenges for auditors. Many times when we see this loan agreements, that too with recently where when you see with private bankers, again they use different wordings. There could be funded and non-funded offers, and in funded there could be multiple varieties of funded loans. Understanding these jargons is something which is very essential. Many times, even though we feel that we are strong in terms of English, the way those documents should have been made will be so complex. Please deep dive to understand what is the objective. Say a very simple thing, there are certain things called lease discounting, and specifically they say how should they use lease discounting. It cannot be for any purposes or anything other than running or maintaining your real estate. So those kind of things you need to be aware of. The challenge which you may face is whenever there is a delay in project completion. Take an example of real estate company where you apply AS7 or guidance note on AS7. You would have identified, you would have projected to construct apartment within 5 years, and you would have made borrowings as per that. But subsequently, for obvious reasons, your construction may take more time, and the moment it takes more time, you have multiple payments which happens, and it may affect the project report, project budget as such. This will impact auditors a lot. Tracking indirect diversions or misclassification of expenditure, one of the biggest challenges we face as auditors. Overheads which are applied. There could be various overheads which is there in the organization. To what extent those overheads are directly related to the operations, whether this has to be considered as utilization for the purposes or outside the purposes. That's again a challenge which we'll face. Correct, of course. So, see again, if it is, if your tool is to that extent, yes, you can do it. Yes, yeah. Or the second thing could be to what extent, again, it goes back to the thing where you have told your client to maintain it accordingly. Put some extra effort, training your client, telling these are the challenges which we will face, and also for them also it is important. They need to substantiate to what extent it has been used. They need to substantiate what is the budget overrun or what is the cost overrun, which helps them over there. As we mentioned, one of the fundamental things for having CARO is to give a comment whether statutory compliances have been taken care by the company or not. As an auditor, we have to have, we make two comments under CARO in statutory compliance. One, the disputed liability, and the other is undisputed liability. Undisputed liability is something where company is fine to make they have not created any, there is no litigation rather, and on a regular basis they are making the payment. So as an auditor, we need to comment, are there any dues which is undisputed but outstanding for more than 6 months? And in that you have huge list. It may be GST, it may be TDS, it may be labor law related, it may be customs, it may be advance tax. All those items will come into picture in this particular clause. And if something is outstanding for, if something is not paid for more than 6 months, or the assessee, the company is not generally regular in making these payments, as an auditor we need to give our comment, which is a negative comment. Otherwise the comment could be the company is generally regular in making these payments. Certain challenges which will happen, which we need to consider here is, what is statutory dues versus what is contractual dues. There could be few cases which are contractual in nature. For example, making electricity payments is a contractual liability, even though it goes to the government. It is not a statutory dues. If it is unpaid, that will not come into picture here. Customs, making a if I have imported and customs duty has to be paid, is it something, should I comment about regularity or should I comment about accuracy? There again the accuracy, because I have to make the payment the moment I have imported the goods. There is no question of periodicity on that. So these kind of analysis you have to make the thing. Then non-payment of advance tax. You have quarterly advance tax requirements, and assume there is a short payment of advance tax. Will that come into this particular clause? Should I have to comment telling there is a 234B or C applicable? Will I have to comment about non-compliance in the CARO? So if you read this, the guidance note specifically tells the comment from auditor will come into picture under income tax, advanced income tax, only when the assumptions or if they have taken a wrong stand. The stand taken by the company was wrong one. Knowingly they have taken a wrong stand, and because of that they have paid lesser advance tax. In such scenario, you have to make a comment. If it is a question about estimations which have gone wrong, I estimated my revenue will not cross 200 crore, but it goes up to 300 crore, because of which I have to pay B or C, then those kind of non-compliances or those kind of delay in remittance need not to come here in the CARO. Expenses accounted for MIS purpose. This happens in most of the ITS entities. So the way they do is, every month end they prepare MIS, every month end they create expenses, and the first day of the next month they reverse the expenses. So how do you demonstrate, how do you comment on this? There are different ideologies which are there. One set of people say if the expenses are reversed before the due date of TDS, there is no question of non-compliance. There is another set which says irrespective of this, it is an accounting principle, and once an expenditure is accounted, even to a suspense account, TDS is applicable. So as an auditor, you need to put your judgment to see what is the impact on the financial statement, what is the impact on statutory compliance, is it going to make a bigger impact in terms of the litigations, then you will have to make a comment here. There could also be a scenario where, imagine a company has again multiple branches and multiple employees, and salary is paid at different dates, and if the salaries are paid at different dates, there may be challenges to remit PF within the due date. So few companies, what they do, they make some PF in advance and they adjust it once they close their process. These kind of activities are fine. It is not something to talk about non-compliance. As an auditor, we don't have to comment on the same. Disputed things could be where the company had got a notice and they have taken a stay and they have gone for litigation, they have taken a stay. Those kind of things, as in CARO, we have to mention what is that litigation which is pending and which is the forum in which it is pending, and other things as an auditor which we need to see whether it has come under the contingent liabilities, whether it is coming under the litigation, what could be the impact which they have discussed about in their notes, are they talking about the risks around that, and what could be the impact about going concern. Those things of course we look at from the other audit procedure side. Yeah, you can pay, because see, and you are just putting onto this, you have to do something called a annual return. In annual return you can update those. So imagine you have 6 different branches, and each of the branches you have different people working on a contract labor also or on a daily labor also. So you need not to be that every time you have to pay 30th is not possible. You will have different dates to make sure HR system is working properly, that you do. Yes, a lump sum rather. It's a lump sum payment. More of estimation, no sir. So unless the shortfall is recurring, 1 month shortfall is fine. If it is continuously happening, then again you will use your judgment to decide. So challenges which we face with the changes which happens with law. All of a sudden we had one issue in our office. There was a comment on the GST side. Majority of the cases, what happens, a company gives guarantee to the other company, and in Ind AS we have a concept of accounting for guarantee, and there were some notices which were issued especially in Karnataka to pay GST on this guarantee. Now the question which comes to auditor is, as an auditor, to what extent we are updated about these kind of regulations. And it's not so easy for us to even comment at one place. And again, there was a confirmation or rather explanation given from the regulator side. Not all the cases you have to pay GST. If an invoice is there and if invoice has a value, then GST is applicable. If there is no invoice, or if the assessable value is 0, then there is no GST. So these kind of challenges when we face, one of the things which we follow, try to take an expert opinion or try to keep the documentation available with you, so that whatever decision you have made is supporting for the CARO which you are updating. And the kind of amendments which happens again in labor laws, there again, for example, you have to say on the labor law side, there is a concept of international worker. When you see international worker, the laws, one set says you have to pay PF not only on the basic but on the gross amount. The question which rises is again from the Bangalore side companies where they give ESOP. So should I consider ESOP as part of the gross salary or no? If I need to consider, PF has to be done including on ESOP. But there is another set of people who say gross does not include ESOP, it includes only bonus. So these kind of information, these kind of concerns which are there in the law or regulation makes our life little complicated while we commenting on the same. And it is not only one of the laws which we are talking about, there could be multiple regulations, and if litigations are open on these multiple regulations, how we analyze those, how do we comment on the status of those litigations, how do we comment about what are the stands which are taken on the litigations, how do we comment about whether those litigations are appropriately disclosed in the contingent liability, that also matters. Few of the other things which has to be reported by auditor is fraud. Fraud, as I mentioned earlier, if the fraud impact is more than 1 crore, there has to be a report which has to go to the central government. Other than that, in CARO, as an auditor, we are required to comment only on cases which is noticed or reported. There has to be a document which is available where the fraud has happened on the company by the employees or outside the employees. Some document has been available and you come across those, and that needs to be disclosed in the CARO. Just reporting, as we say every time they keep on telling, just reporting does not relieve ourselves from our audit process. We need to still perform our audit process, have the evidence in such a fashion to say that fraud amount what has been disclosed is only that much and it does not have a multiple impact on the financial statement. How and from where and all you can get this information? Internal audit reports are one of the major sources for you to get information about fraud. Understand what kind of scope which was given to internal auditors, read the internal auditor reports, read audit committee reports, understand what items were disclosed, was there any communication about the fraud, identify those evidences, then you can go deep dive into the same. Whistleblower complaints, again in CARO we have to comment on, are there any whistleblower mechanism. What exactly is whistleblower? It's a concept where the individuals or outside people are allowed to send their concerns to a team and talk about these are the areas or concerns in the organization which may create a negative impact on the financial operations or the company's operation. So who is responsible to have whistleblower policy or other committee? Every listed company need to have whistleblower committee. Companies which accepts deposit from the public should have a whistleblower committee, and companies which have borrowed money in excess of 50 crore should have a whistleblower committee. So what happens as an auditor, make sure that you understand the policy which they have. You make sure that those people or the person who was responsible for managing whistleblower has the communication open and the data is going to the whistleblower. The way it works in majority of the meetings, this whistleblower chairman shares about whistleblower policy what he has. He mentions what the way in which people can reach out to him. An example which I can tell you recently which had happened in Twitter, they have one of the biggest, one of the good whistleblower policies, and you can write to them and tell what are the concerns which you have about the Twitter India. So like those kind of things, you need to be aware of who is running this whistleblower, who is managing whistleblower committee in the organization, and you need to have interaction with them to understand are there any concerns which have been raised. Challenges in this: identifying fraud risk and performing detailed procedure to detect fraud. No matter how much time we spend, many of the times, if the fraud has happened with the intention of someone who is very strong, it is almost difficult for an auditor to find that this fraud has happened, and the risk will always be there on us. Difficulty in detecting transaction authorized by top level executives, of course. Difficulty in obtaining confirmation evidence from external parties. These frauds, one of the another reasons for fraud is that I'll be showing some transactions with one of the vendors or one of the customers, and I do not, as an auditor, I do not collect vendor confirmation, or rather they are not ready to share the confirmation with us. Just like that, if we leave it, then again we lose out that identifying the fraud. Internal audit function may not adequately address or identify the fraud risk. Related parties, as mentioned, as per the accounting standard, the management or the company has to make disclosures of related party transactions in the financial statement. In 44AB again, we talk about 48(2)B in the tax audit report, where a tax auditor has to comment on related parties. The additional requirement to disclose related party is there in CARO. What has to be disclosed? Section 177 and 188. 188 speaks about transactions with related parties in Companies Act. What it requires, whether these transactions have happened at an arm's length price. What exactly is arm's length? If you go and read those sections, arm's length is something where if I need to have a transactions with a third party, the way I enter, have I entered the transaction with related party also in the same fashion. So we have various ways in which you can find out arm's length pricing. There are certain specific sections also under Income Tax Act which helps us to identify arm's length pricing. Obtain all those information and then you will be able to comment on the arm's length price. When it comes to section 177, it is audit committee. There are certain entities, specified entities which require to have audit committee, and whether you had audit committee in place and you have performed, rather the work is performed by the audit committee, have you verified what kind of transactions they have done, what kind of communications they have had, what kind of discussions they have had. As an auditor, you need to comment on that. Non-cash transaction with the directors, this is one additional disclosure which as an auditor we need to comment. What are the non-cash transactions which happened with the directors in the organization, whether you have disclosed it. Again, pretty much difficult to identify unless you know all the list of all those directors, what kind of transactions you might have had with people who are connected with the directors. Those lists you need to keep in mind. Challenges to auditors: change in related parties during the year due to mergers, acquisition or changes in the management. When there is a merger, on an overall basis, there could be new companies which come into picture. The company which was never a part of your related parties may become a related party now. A director a key manager person who was never a KMP before can become a KMP now. So keeping a track of this list is something which is very important. Very simple thing which can happen: all of a sudden one of your director's spouse starts earning salary from the company. So it's very difficult to find out the relatives of directors or KMPs and the payment which is happening to them. And those disclosures, the way in which you can do, again, your system should be strong. You should have multiple interactions with the client, get the information about all the related parties, find out MBPs, find out the specific agreements which they have entered into. Through that, try to identify all the related parties. Omission or misrepresenting of transaction due to management oversight. The way it can be resolved is have a reconciliation mechanism. One of the things which we follow is whenever we draw related party transaction, we try to reconcile the opening balances, transactions and the closing balances. Many times we will be able to find the errors over there. Second thing could be using other disclosures. One thing which we follow whenever we do statutory audit where transfer pricing is applicable, the transfer pricing team would have done detailed analysis, try to make sure those disclosures which are coming under transfer pricing has come in your financial statements. Lack of documentation or benchmarks for pricing, if you are not following, rather in majority of the companies where there is no transfer pricing, this benchmarking is not something which is done on a regular basis. And this challenge is always there for the companies. So as an auditor, it is your responsibility to have the relationships, the analysis of the transaction with relationships and without relationships. There could be scenario, the way it can be done is identify who is the related party and also identify who is not a related party, compare the transactions and make sure at least the profit margin is more or less same in the both. You can give adjustments maybe for risk factors in terms of credit risk. You can make the adjustments for marketing risk, and after making those adjustments, if profitability is almost same, then you can deem that the transactions are at arm's length. The various examples which can come into picture, which you will face is the company is a manufacturing and one of the vendors is related to the directors. The company is a manufacturing, marketing team is related to a director, and director's spouse has joined as a say HR head of the company. So it is, they may be professional. One of the things which we also check is, are they professionals? What is their background? Go back to their LinkedIn status, go back to their past records, understand what kind of activities they have done before. These evidences will give you some idea to say whether the transactions are at arm's length or not. Now, this is one item which is pretty much important when we comment on CARO. Internal audit. Internal audit is not applicable for every company. It is mandatory for listed company. For other than listed company, there is certain requirement. For example, the simple thing is, if it is a private limited company and turnover is more than 200 crore in the last year, the subsequent year onwards, internal audit is applicable. So what has happened in CARO? With CARO 2020 coming into picture, it is important for statutory auditor to say whether the internal audit exists in the company, and if it exists, does it commensurate with the size of the company, which was there in one of the earlier year CAROs. In between it was removed and again it is brought back in CARO 2020. So how this has a bigger impact on the statutory auditor? As a statutory auditor, many of the times we have seen, just because there is an internal audit team, we go ahead and say internal audit exists and it commensurate with the size. But there are certain things which as statutory auditor we need to keep in mind. First thing, we need to see to what extent the scope is different. Is that scope is something which applies to the organization. Imagine the company is ITS, or imagine the company is into e-commerce, and it is into e-commerce. The internal team is not even looking at cyber security. It is e-commerce. the internal auditors are not even looking at how P2P securities are available, then as a statutory auditor, it becomes one of the biggest risks for us to rely on the internal audit report and comment or rather give a statement telling internal audit exists. Another thing, to what extent this internal audit team is independent from the organization. We have seen scenarios where when rotation comes into picture, the statutory auditor will become an internal auditor. It becomes more of a scenario that I am giving something, I should get something back. So you have to be careful. If at all you are the statutory auditors in these kind of scenarios, how do you verify those? I am not telling you should not let those people do, but whether the assessment has happened properly, whether the internal audit team has enough employees who understand what is risk. A statutory auditor who is asked to do internal audit itself shows an evidence that they may not have that much of expertise on the internal audit. Scope of internal audit and assessment of risk, something which is again essential. To what extent as a statutory auditor you are involved in identifying the scope, to what extent as a statutory auditor you have done the assessment of risks. So risk assessment is basically an analysis of the financial statements and the financial operations of the company to say in revenue, in sales, what are all risks the company has. Say it's an educational institution. In education institution, we know that the company will, other entity will charge X amount of tuition fees or education fees every year. What risks could be there? There may be a scenario where there is someone who is using today everywhere they use Paytm or Phone Pay and etc. What risk could be there? Is there any possibility that one of the wardens is using his phone number instead of organization phone number to collect money? So there is a internal control issues. There could be a internal risk, one of the risk over there. Second, same institution, they are collecting some additional money in other than the fees. Fees is 2 lakh rupees, but he is collecting 2 lakh and 20,000 rupees. Where is the 20,000 rupees going? So that could be another risk. So when you go and analyze these risk statements for each institution or each organization, you will be in a better position to say whether the scope what you are given for internal audit is good or is it sufficient. Then audit documentation about assessment of IA function. As a statutory auditor, this is one of the fundamental things. Before even we start the audit, let us spend some time understanding what are the risks which are there and what work has been assigned to the internal auditor. Impact of internal audit on FS to be verified and updated by the management. Generally internal auditor works on a periodicity which is better than a statutory auditor. He may do quarterly or he may do half yearly. To what extent management is identifying those risks which are identified by the internal auditor, to what extent management is reacting to those, whether those has been given effect in the financial statement is something which we need to be concerned about. Finally, the impact on internal financial control. So what exactly is internal financial control? We all know there is one annexure which we have to sign, which is about internal financial controls, that these internal financial controls are those controls which are there which supports the maintenance of books of account and preparation of financial statement. What we say over there, IFC was proper as on the balance sheet date. Because of these internal audit assessments, we need to have a clarity that is it affecting the IFC control, internal financial controls. There is a separate appendix where we comment on it. This has an impact, this may have an impact on the IFC. Challenges to the auditor: assessing the adequacy and effectiveness of internal controls requires additional testing and documentation. We need to sit with internal audit team, we need to sit with risk team, we need to sit with again process owners, understand what kind of system review they have done, what are the observations internal auditor has given. Internal auditor gives a big report, we need to review those and test those controls also. IFC testing also happens during our process. We go and verify those controls and we have to give our comments. Maybe certain times the comments of internal auditor may not be material as a statutory auditor. Maybe sometimes internal auditor might not have given a high risk, but it could be an impact on the statutory auditor. So this assessment takes additional time. This assessment requires additional expertise. Absence of formalized internal audit charters. I'm not sure how many companies will have. There are major companies which has this, and these internal audit charters or frameworks as simple having a SOP in an organization, standard operating procedure in an organization, as simple having a maker checker concept inside an organization matters a lot for us as a statutory auditor, and to what extent these things are available in the company makes the statutory auditor's comment on the CARO in a different way. Challenges: internal auditors reporting directly to operational management. We should also see who are these internal auditors reporting to. The requirement of the law is internal auditors should report to the board. They need not to report to the process owners. They need not to report to the operating heads. There should not be any sort of cross-line relationship. It has to be direct line relationship to the board. Focus on routine financial operating areas while ignoring strategic risk, which is cyber security, compliance, fraud. Lack of technical expertise. As statutory auditors, our expertise on IT controls, our expertise on SOCs, our expertise on forensic activities will be very limited. So it is very important that we have that kind of people within our organization where they can help us in these kind of audits. Of course, this need not to be for all companies. Imagine you are doing an audit for a e-commerce platform entity, the entity which provides platform for e-commerce. To what extent you have done the analysis of forensic. Imagine you are a company which is doing R&D facility, which you have a R&D facility for an entity which is outside India. What are the kind of IT controls you have? Internal audits many times are conducted on a different timeline. So this is one challenge which we face. First quarter internal audit report we will get. Second quarter, third quarter internal report will never come to us. The reason may be, one of the standard reasons which we hear is second quarter, September, client is busy, auditor is busy, that report may not happen. Third quarter, December end, that report may not happen. Imagine the impact on the statutory auditors, imagine the impact on the company. Try to assess all these things and make sure that your analysis, when these kind of things, as a statutory auditor, you need to put your foot into the role of risk assessment, into the role of IFC testing, and get enough evidence for the same. Internal audits reports may lack actionable insights or sufficient evidence. Another important another challenge which we face, internal audit report comes to us, there won't be any actionable items. They just tell some error has happened, that is the comment which they give, but what are the actions which they have taken, what is management required to do, what kind of system advancement they need to have, those items are not available. So what happens, first year they give one report, second year again they repeat the same observation, third year also same observation comes. No support or no value addition to the company, neither to the company nor to the statutory auditors. This is one of the I would say complex reporting which happens in a company, which is on the section 45 IA of the RBI Act. So what exactly this is, in simple terms, as an auditor we need to comment whether the company is required to be registered as a NBFC. So there are two thumb rules which works in terms of NBFC, whether the company has a financial income, whether the company has a financial asset. Those are the two things. Financial income, if the total financial income of the company is more than 50% of the total income of the company, and the financial asset of the company is more than 50% of the total asset, then there are chances that this entity may be considered to be a NBFC. The moment this entity is deemed to be an NBFC, it is mandatory that they should obtain RBI approval. Not that anybody can get into financial activities. There are specified entities who have to follow RBI guidelines. As an auditor, we need to comment on this. So where exactly we face these challenges? Imagine, again to give an example, manufacturing company was there. Manufacturing company had various joint ventures they come up with, and they make 2 or 3 subsidiary companies, and the main company becomes the shareholder of these 2-3 subsidiary companies. Then there are chances the main company could be deemed to be a NBFC. Or imagine there was a company which had operations, which had real estate also. After 30-40 years, the way it works in Bangalore, the real estate will become such a big thing. Their operations will be very nominal. Real estate gives them a good fortune. What they do, they exit the real estate, they get money, and they start investing in shares or market. These kind of things can be considered to be a NBFC. So you need to be aware of the guidelines which are given under RBI, which is section 45 IA, and if by chance, if your financial income and financial asset matches or rather comes into the threshold, then you need to comment whether approval has to be obtained. If approval has to be obtained, have they taken the approval? Few things, the moment you are NBFC, there are few comments which you need to make in the auditor report. Whether you had collected whether you have a valid registration of NBFC, you need to comment in the CARO. Second, whether you have the minimum NOF. NOF under NBFC is net owned funds. Today there is an amendment which is going on over there. The proposed one is 10 crore. Otherwise NOF is 2 crore, meaning to say an NBFC should have minimum 2 crore of net owned funds available with it to continue be considered as a NBFC. So what is not included in net owned funds is when I compute net worth, it is basically the share capital and free reserves. But when you compute net owned funds, you need to make certain adjustments. You may take share capital and free reserves, but reduce deferred revenue expenditure, reduce deferred taxes, reduce certain transactions like investments with the subsidiary companies. There is a formula which is given. Any amount in excess of 10% needs to be reversed. So basically what they are trying to tell is the transactions with related parties will not give you that much of net owned funds. That is your own entity. You do not have any sort of recoverability over there. Excluding that, if you are able to manage 2 crore, you are deemed to be NOF compliant. CIC, again one comment which is there in CARO, core investment company. Again, it's something to do with nowadays people call family offices, etc. So what exactly core investment company meaning? Their objective is to invest on other companies. If more than 90% of the asset is basically the securities in the group companies, then it can be considered to be a CIC, core investment company. And if a core investment company is not taking any deposit, and if the amount is less than 100 crore, then you don't require to register. You may have to comment. You can tell it is a core investment company, and if they are deposit taking, they have to take registration. Even in NBFC, you have a concept called deposit taking, non-deposit taking. There can be many NBFCs which are not a deposit taking. The moment an NBFC is not a deposit taking, the compliance is pretty much simple compared with the other NBFCs. Cash losses. Today morning Mohan sir was talking about cash flow statement. Cash loss is something as a auditor we need to comment in the CARO. What exactly is cash loss? If you read the whole guidance note, there is no comment on cash loss. Nobody is talking about cash loss, even though the word cash loss is used over there. But how it can be computed is given in the guidance note. Simple terms, profit after tax plus rather adjust non-cash transactions. It could be depreciation, it could be amortization, it could be intangible amortization or tangible amortization, it could be impairment. All those things which are given in accounting standard 10 or Ind AS 16 needs to be adjusted. So what is the reason for identifying cash loss? Going back to the original principle of accounting, the financial statement is prepared on a going concern basis. So as an auditor, one of the evidences, or I would say one of the analytic tool to check whether the company is going concern or not is checking whether the company is making cash profit. So this may not apply to the companies which are there in Bangalore. Majority of the cases, they may all this e-commerce, the startups, they do lot of cash loss, they burn cash, but this can be considered to be one of the reasons to say whether the company has any challenge in the going concern. So when the challenges which we face, company has incurred cash loss in the financial year and in the immediately preceding that, how do you compute the immediately preceding cash loss? Then ensuring availability of accurate financial data. For current year, I may have that. Imagine I am the auditor for current year, previous year audit was done by someone else. Then we will have challenges to compute how they have computed. The same challenge what we face when we do 44AB. In 44AB there is one clause where we talk about ratios. Every time I have seen, even when we repeat on the things, the way we take the numerator and denominator, there may be certain changes. So this challenge we may have in computing cash losses also. Confusions between accounting losses and cash losses. Again, there are various accounting concepts which has come into picture. So identifying whether it goes to the cash loss or it stays as accounting loss is something which we need to be clear about. Adjusting for one-off transaction that do not reflect ongoing cash flows. As an auditor, you have an option to give a comment. This is one-off transaction which has affected the cash loss. You can still give a positive comment using this. Assessing whether cash loss indicate broader financial distress. Just there is a cash loss doesn't mean there is a impact on the organization. You have to go deep and analyze what could be the impact, and the only way to get information is understand the future business, understand the kind of WIP they have, the kind of new business they are entering into, the kind of customers they are entering into, what is the investment which the company is doing, get as much information as possible. Auditor resignation is again a beautiful clause which has come in CARO, which made majority of auditors' life easier and simpler. Couple of years back, there came one trend telling majority of this listed company auditors started resigning immediately once they felt that there are some challenges, and this created lot of issues with various people. So SEBI came up with a guideline how an auditor can resign if they are part of the listed companies. In a similar way, for these companies, what is important is, if I am the new auditor, if I am taking an audit for the first time and it is coming to me from other auditor, it is my responsibility to understand why that person resigned from the company. There could be hundreds of reasons. We need to be bothered about, was there any concern about scope? Was there any concern about the overall presentation of the financial statement? Was there any concern about the timeline? So there could be various reasons why an auditor would have left. It is required for us to understand the reason and comment the same in the auditor report, that is CARO. The challenges which we face, many of the times it is difficult to understand whether the concerns raised were technical or operational. Again, like how we say, each person has his own judgment. So their judgment and my judgment, how do I reconcile those? That is something which is important. Evaluating the significance of objections in the context of audit scope and reporting. At least we have seen with various people how audit scope affects the auditors, and there are few cases where auditor resigns, quoting audit scope as one of the limitations. That if at all that is one of the limitations, the first question could be whether you are okay to take it. In professional ethics, how does it matter if you have to take it or if you have to reject? That is something which you need to keep in mind. Assessing the adequacy of procedure performed by the outgoing auditor, identifying areas that require rework or additional testing. There was an auditor, he has given a statement telling there were some challenges. That is why he has resigned. Now the question for you is, how do you analyze those transactions of last year, because those transactions would have become the opening balance for you in the current year and you are responsible for those. So what kind of additional procedures you do when there was a resignation, and how you have taken up the financial statement, and how still you can give your opinion is something which is important. Material uncertainty in financial position. This is again on ratios, one of the last clauses in CARO, where the whole objective is to say, looking at the financial ratios, does it seem that the company will get into material uncertainty? Again, this is only a comment, it doesn't guarantee either going concern or not of the company, but it gives you some idea how ratios are working, whether ratios, rather the way there is a strong statement in market, they say trend is your friend in a market. The similar way, how the trend looks in the financial statement, how my current ratio is looking, how my PBT ratio is looking, how my debtor ratios are looking. So these are the things it is required to be disclosed in Schedule 3. In Schedule 3, you should also make a disclosure of last year and current year, and whatever is the variance, if the variance is more than a defined percent, which is 25%, you need to substantiate, rather you need to explain why that delta came into picture. So similar thing, as an auditor, you comment here whether the financial ratios gives any sort of negative impact about the future of the company. Analyze the financial liabilities as on balance sheet date. You need to, for you to give a better comment on the ratios, you have to do some additional procedures, take up all the financial liabilities, understand what is the impact post balance sheet, review correspondence with the lenders, obtain subsequent payment status. Recoverability of financial asset is again an important thing. Financial asset keeps on piling up, you are showing a better net worth, but to what extent it is getting converted into liquidity is something you need to comment, you need to think about. Comfort letter, this is something which happens in majority of the cost plus companies. So what happens, if there is a parent outside India and a subsidiary in India, and for obvious reasons there are certain challenges in the cash flow, and the way it works is, parent will give a comfort letter to the subsidiary telling, for any obligations of subsidiary I will take care. So as an auditor, it is your responsibility to see what is that the comfort you can take based on the letters which are given by the parent. Do you really think the parent will be able to take over the responsibility of the subsidiary, or it is just a document with no value? But if they are not making revenue, here there is no loss because of your TP thing. What if that fellow is not making? Say they are developing a product, and for that you have used your people. For transfer pricing you are doing cost plus and you are billing them, but they are not making you payment.
Then how will the normal day-to-day operations has to go?
That is the thing, no? That is why you have got a comfort letter. With comfort letter, can you agree? So what are the additional challenges you will have? There, one of their customers will become bad. They are not able to pay you. Here, because of your cost plus, you are building cost plus 18%. Just because you have a profit doesn't mean that you are able to run the show. Take MIS, interim financial statements, cash flows for next 12 months. Analyze how the numbers are changing vis-a-vis the current financial statement and evaluate the same. Guarantee to others, wherever you are given guarantee to others, again most important thing, whether this guarantee can become a challenge for you. Can it put you down in your operations? Challenges for audit, management projection may be overly optimistic, like not that whatever they give. Today we know what kind of valuation they give for startups. So how do you ascertain those assumptions are right? How do you evaluate the assumptions behind the valuations are up to fine, and the way they have arrived is something which is acceptable. Interpreting ratios in case of significant industry variations. Multiple industries have multiple ratios, multiple things can happen. Their manufacturing company may talk about production per plant, service industry may talk about recovery per man hour, and real estate people may talk about a number of million square feet sold. So these multiple industries create multiple expectations, and multiple ratios will have multiple impact on the financial statement. Determining which ratios are most relevant to the company's operations and risk profile. If I'm a company which is into, say, project management, my turnover to fixed asset ratio could be very high. That doesn't mean that I'm doing good. So I need to be aware what is that ratio which I need to consider. Just because turnover to fixed ratio is one of the universally used ratios doesn't mean that I can apply that across all the companies. Identifying all liabilities including contingent and off balance sheet. Many of the times in our ratios, whatever we disclose in schedule 3, we do not talk about contingent activities. So as an auditor, when you comment on this, you need to consider what are all the things which are there off balance sheet and how it can affect the financial statement. Limited access to relevant non-financial data. In the previous meeting, in the previous session, sir was telling the CEO and CFO going out of office, they going to a club and result making some sort of impact on the financial statement. Not that as statute we will never be having access to those. So how do we get those information? The only way, have as much as discussions, have try to make as much of visits as possible to the client, get the information from them, try to get those information from them, and to that extent it will help you in your operations. Limited impact of sector specific challenges such as supply chain disruption again. So one of the last ones, CSR funds, corporate social responsibility. As you all know, section 135 of the Companies Act, the first section to be Companies Act 2030, when it came, the first section which was released, right sir, which was made applicable was section 135, and schedule 3 came up with a disclosure for CSR, section 135, and that got amended. And one of the first provisions where people started getting notices for non-compliance was again section 135. Section 135 is again something where regular rules also got amended in a very short span. So multiple things has happened around section 135. Keeping that in mind, maybe one of the reasons why they have brought it here, as an auditor, we need to comment the compliance with CSR. In CSR, there are basically there is something called Schedule 7 in Companies Act, which tells about for what purposes a company can donate money for. So CSR, the whole objective is, if a company is situated in India and having a profit of say 5 crore or more and few other things, they are obligated to spend 2% of their average profit for the corporate, for their corporate responsibility. And it is advised to do CSR activities in the place where they are located. They have given few objectives which you can use it. You can spend money for education, you can spend money for women empowerment, you can spend money to make sure the life of individuals are improved. In addition to that, there are few things, like there are two more major things, which is funds. PM Care Fund is one where you can give the money for. So those are called funds, and the other ones are called activities. Who can do CSR? You can either give directly to a trust and get it done from them, or you can have your own trust and do it from there, or you can directly transfer the money to funds. So if at all you are giving any money to a trust which does CSR activity, they need to have 3 years of past experience of doing it. If you are doing your own NGO, whether section 8 or a charitable institution of the company, then the 3-year background is exempted. You can start it from day 1 itself. So this 2% is computed on an annual basis, and this has to be spent before 31st March of the financial year. Again, what we have to comment is 2 things, which is ongoing project and other than ongoing project. Ongoing project means a company decides to do a particular project which runs for more than 1 financial year. I start in this financial year, it may get over after the end of the financial year. In those cases, there is a separate set of compliances which is required. Other than ongoing, meaning I have to just spend the money, I have decided, I have a CSR committee, and again CSR committee is another concept where the liability to spend is more than 50 lakh per annum, then CSR committee needs to have, they will decide where they make the expenditure on. For ongoing activities, if the company has not spent the 2% before financial year end, then they have been given 30 days to transfer it to a specific account. So I am running a project, say for example, I have decided to build a school for students. That will take more than 1 year to complete. As on 31st March, my project was say 10 crore rupees. I have spent only 2 crore. Balance 8 crore. Within 30 days of the end of the financial year, I need to transfer to a specific account, and from that account I should spend the money for. Other than this, I have 6 months time. If I don't spend within 31st March, within 6 months they should transfer it to specific fund, PM CARE and those funds which are already prescribed. So as an auditor, we should comment whether they have spent the money, and again they under schedule 3 they have to disclose CSR, how much was the CSR they are liable to pay, how much they paid, is there any difference of what they have paid, all those disclosures they need to mention, capital, operating, etc. And one again condition here is you cannot use CSR funds for the enhancement of the objectives of company. Meaning to say, assuming I am a paint company, I cannot do CSR which invariably supports only the people who use paint. For example, paint men, I cannot use only for them. Or I am a company, I cannot have a school which takes only my employees' children there. I should create it more of a social thing. The school should be allowed for everyone. So something like that which has to be taken care. And one thing which has come, provision for unspent, assuming in 1 year the company has spent more than 2%, that balance amount they can carry it forward and they can use it for any of the next 3 years. That 3 years they can use either for specific objective or any general objectives. The unspent money, they should create a provision, and auditor has to comment whether the provision has been appropriate or not. Challenges for audit: incomplete or inaccurate records of CSR expenditure, discrepancies between CSR disclosure both in financial statements and the CARO. The last one in consolidated financial statement, this is clause number 21. This is not applicable when you do standalone financial statement. This comes into picture when you are consolidating the financial statement. As an auditor of consolidating financial statement, you need to comment were there any adverse remarks given by the component auditors. Who are component auditors? Basically those who are auditing the components of the group. Components of the groups are nothing but all the entities within the group below parent. So if the other auditor has made any adverse remark, you need to comment on that in the consolidated financial statement. For example, one of the subsidiaries auditor has commented on clause 2 inventory, telling there was no physical verification done. So consolidating auditor has to comment in 21 telling in this entity for clause 2 there was an adverse remark. That has to be there. Few concerns which will come here, it's actually straightforward. Whatever they have given, you are copying and pasted in the consolidated financial statement. You cannot look at materiality. What it is deemed that when someone has made a comment, the other person who is an expert who has made a comment, you have to follow it and you will take it here. And the challenges which you may face is you are about to complete the consolidated audit, but the subsidiary audit is not yet completed, or their reports have not come to you yet, or component auditor has given the report but documentation is not good and you are not able to understand why specifically the component auditor has given a qualification or a disclaimer. Assessing the cumulative effect of qualification on the company. Say there are 3 subsidiary entities, each of them have commented on inventory. what could be the impact on standalone, on the consolidated inventory as such? Can this have an impact on the consolidated inventory? As a statutory or as a consolidating auditor, it will be challenging for you to understand unless you have a system where you discuss with those component auditors, understand their materiality, understand their procedures, understand the evidence what they have had to comment this, and then you will be in a better position to comment. Avoiding omissions or misstatements, something which happens. Imagine the parent entity has 10 subsidiaries or joint ventures. You need to consolidate all 10's comment, and that is more a manual work. There are chances that there may be some manual error and you may miss out few things. Other clauses, there is something on deposit or deemed deposit, section 71 to 73. Deemed deposit is basically a company has collected advance which is more than 12 months. There is a background behind it, how it has been done. If deposit is taken, whether DPT has been filed, whether it is in compliance with the DPT, you need to comment on it. Maintenance of cost records, not applicable to every company. There is a defined set for whom cost record is applicable and not applicable. Wherever applicable, you will give a comment on it. Unrecorded income, again this is something which has come in the CARO 2020. If an assessee, rather a company, has accepted that in the previous year I had not recorded income, now I am offering it for taxation. And as a statutory auditor, you need to comment about that. The challenge is not about disclosure. The challenge is why this unrecorded income came into picture, how was it not recorded in the earlier years, how it came into picture now, what could be the impact on internal controls, and how did I conclude the financial statement to be true and fair. So many of the things which will open up. So you need to be very careful when you analyze this. There could be many, no? Yeah, the guidance note has. So recommendations for CARO: spend as much time as possible when you plan your audit engagement. So have the team completely spend good time on planning, because you cannot do a CARO report unless you have defined the procedures during the audit. Your audit procedures for fixed assets should be so strong enough which allows you to comment on CARO clause 1. Your audit procedures on statutory compliance should be good enough to build all the matrix which is required for commenting on any dues unpaid or any dues paid which is not generally in time. So effective communication, have as much as interaction as possible with the management. So I would say thanks to Ind AS, Ind AS helped us, our team, to have this interaction with the client more dynamic, because majority of the things in Ind AS it is rule based, where if you have to apply Ind AS 115, the entire team in the organization should understand what Ind AS 115 is. Marketing team should know what is Ind AS 115, accounts team should know what is Ind AS 115, and of course credit appraisal team should also know about 115. So why I am telling you this is, have as much of meeting as possible, communication with the team, process owners, process users, and this gives you enough information to make sure your CARO is good enough. Detailed documentation to support you. Marketing team will know, right? The credit, for example, if I need to apply is what is that called? Variable consideration. Yes, they should know how their contract will affect the top line of the company. I give a contract telling I am giving you only, say for example, AMC transaction could be, or it could be, as he said, variable considerations. So those things they should understand how their agreement affects the top line of the company. Training and awareness, make sure your team is well aware of each clause and they are the ones who go and work. They should have enough data with them to question the client. They should have data to document it, and whatever data comes to you is something from the team. Keep them as much updated as possible. Finally, FAQ set office, which all of us follow. Have as many FAQs as possible, and that is one of the simple ways to make life pretty much standard. Whenever you come across any challenge in the audit or in the transaction, write it down and find the moment you get the solution, update the solution and keep it flowing. So the new team comes, they will understand what was the challenge which we had in last year, update, and they will be able to appreciate in a better fashion. Once they know this is the challenge, say for example, I'm a last mile company, I will know what are the challenges in revenue. I need to depend on third party to give their confirmation. Until the confirmation comes, I will not be able to recognize revenue. So when I know this FAQ is there in the company, in the audit file, the new team which comes, they will understand AS9 is not so simple in this organization. I need to spend more time on the documentation and reconciliation, and they'll be in a better position to perform their audits. So I think this is it. 21 clauses of CARO. Maybe thanks a lot for the time.
Thanks, CA Vikram, for the exhaustive session. The Karnataka Express non-stop. Thank you. Very interesting. Now we'll break for tea for 15 minutes.
5 overs to play now. And I'm not giving you number of runs you have to score. 2020, okay, whatever you can take. You can take it in any manner you want. So we'll speak a bit about financial reporting practices, sort of combining what we have been hearing from the morning. One is that, of course. And second is also talking about some of the errors, some of the mistakes which many regulators are today finding that audit firms, auditors have probably done in their audit reports. It could be financial statements, it could be whatever it is, right? So I think that's one of the things which is also a cause for concern is the fact that so many people are pointing out mistakes in our work today. That's a real cause for concern, because previously it was our own, territory. We did not have so many people talking about it, but now you can look at it. We see a lot of people commenting on this, but I'll come to that and how do you probably also solve that. So the first question we have to ask is, why should we be a little bit more careful on financial reporting? I think I've already answered that question. The question is that people are looking at our work a little bit more seriously, in fact, very, very seriously. I still remember this, 2009, when Satyam happened, the day he announced whatever he announced. We were in Hyderabad. We were going from Hyderabad to Nellore for a conference, not on Satyam, some other conference. There were a couple of people in the train, so we were talking about Satyam and generally. So one lady asked us, who are you people? Where are you going? We said, we are chartered accountants. We are going to Nellore for a conference. We have got nothing to do with Satyam. We had to clarify it. Immediately we had to clarify it, because otherwise there could have been a problem for us. Very big problem, correct. But at that point in time, I'm saying. But she was very curious. She asked, what happened in Satyam? So we told her, madam, we only know what you know. We don't know what is the exact details, but don't worry, it's a one-off transaction. So maybe it will not be repeated like that. So don't worry about it. She seemed to be contented with that reply. But if I'm traveling, in fact, tomorrow morning I'm traveling by Shatabdi to Bangalore. If I meet that lady, and if there's something else which is reported, she will not ask which is the company. She'll ask who's the auditor. So the view which everybody has got on the auditors has completely turned 360 degrees. Completely turned 360 degrees. So that is why the...
Actually, after Satyam episode, so many persons have started joining CA course.
Okay. But now they've stopped now, recently. Over the last few years, they've stopped joining CA course also. Everyone is looking at the work we do. Please remember, I'm not talking only about NAFRA here. Look at SEBI. Look at the Brightcom report they've given on what SEBI has given on this company called Brightcom Group. They're looking at it. Income tax department. If you see a few orders of income tax, they are saying auditor has not done the job properly. High courts, certificates given by some chartered accountants. High courts have said that CAs have not done their job properly. No wonder Vikram was just telling me this recent attempt from his office, 18 chartered accountants have passed. Not a single person wants to come to practice. No, he just told me this. Not a single person wants to come to practice, which is completely understandable. They don't mind getting into industry, whatever industry, any job. For all you know, they'll be doing bank reconciliation. But they're okay with it. At least this pressure of, this job and whatever it is, doesn't come there. That's the one thing. Not one person, you're right.
It's become a thankless job. And opportunity industry is much better than.
I completely buy that. The opportunities, and in fact, when you say opportunities, see, I've got a view on this, right? And the view is that don't join. I tell all my people who qualify, don't go for a salary. Don't join for salary. I always tell them that because they always look at, Bangalore has got this fantastic, campus placement service in which one company from South Africa comes every year and appoints chartered accountants. So one of the articles who passed, he wanted to go to South Africa, 75 lakhs salary. I told him, do you know where South Africa is? You forget going there. Do you know what the risks are in South Africa? I told him, it's tremendous risk there. You may probably not come back also. So I said, think of that. At least here in Bangalore, you join some company, you're okay with it. So you got to balance that out, right? But yeah, I get what you're saying. And I think it is a job of the institute to give a little bit more excitement into our practice now. It's not by publishing educational material. Definitely not. We've got enough of educational material. It is time that we take on whoever the regulators are. We try to tell them what we are doing. Please remember that, and this is something which we really have to appreciate about the institute. You name one area, you have a publication from the institute. You name any area you take. It could be Ind AS, it could be AS, it could be auditing standards, it could be CARO. Vikram spoke about the CARO reporting, the guidance note. There is a publication. Whether it is relevant or not is a different issue altogether. But they have a publication and they're working on it. That's also the point there. But in this present situation, what is going to happen now is that this risk-reward ratio is completely going towards risk only. There is nothing called reward here in this. I will give you an example which actually, will probably put this entire conversation in the right light. We are the auditors for a listed company. And the audit fees is, shall I say, reasonable. I'll not say very high and all. I'll say the audit fees is reasonable. Compared to the other audit fees, is quite reasonable. And obviously, when this company went for an IPO, one of the questions which was asked by one of the lawyers was, what percentage of your company's audit fees or your firm's audit fees come from this one client? And the reason why they asked, this lawyer was based in Singapore. The reason why I asked this question was, over-dependence on one company should also be considered to be a risk. You can't depend on audit fees only on one company. Peer review also is there. One of the peer review questions also is that, how much is your percentage from this company? So we did not take it very seriously. We said, okay, madam, 10%. We told her 10%. So she noted down, obviously she noted down 10%. And we were also appointed as auditors for that IPO certification. After about a month's time, she said that we want to get into a due diligence call with you and we want to ask you a set of questions. We said, okay, ask the questions. Questions were the same only. Were the firm or any of the partners guilty of professional misconduct of ICAI? That they don't know, no? We won't tell. We told her no. Fourth question was, how much of your fees comes from this one client? I had completely forgotten this 10%. Thankfully for me, she repeated and said that in the previous call you said 10%. I said the previous call was 1 month back. It could not have changed, no? It obviously remained the same. It will obviously be 10%. But that is the risk we are facing. The amount of fees we get from a client also becomes a risk which we have to look at in terms of this thing. Anyway, so we've got all of these things which we do. But I'm going to talk to you a little bit about FRRB today because I think, again, here, this is a system which the Institute has brought in, which is working even as we speak today quite effectively. They appoint groups of chartered accountants and they ask them to review the audit reports of companies. They are focusing more on the audit reports. Of course, also disclosures. And ask them to comment. In fact, it goes in two ways. There's somebody called as a technical reviewer. He reviews the audit report and reviews the financials and disclosures. He gives his report. The institute sends this report to a group of people and asks them, do you agree with what they're technical? So it's a two-way process. It's a two-way process. And I've been part of this FRRB right from 2010 onwards in Bangalore. 3-4 groups we have got. And we've given our comments, of course, on all these things. It works as a sort of a peer review system for the auditor of that particular company. Suppose I give you 100 FRRB reports. Okay, I'll tell you this also. What happens is that if the findings of the technical reviewer and the FRRB group are a little bit severe or a little bit anti-company or there's a complete violation, the institute will refer this to regulator. That's point number one. They'll refer it to the regulator. If it is of grave nature, it will go to SEBI, it will go to RBI, who are the regulators. If the offenses are not very major, spelling mistake, comma, full stop, not necessarily that type, but some small omissions are there, they have an option of giving a warning to the auditor and telling the auditor that please be a little bit more careful in the future. So there are 2 or 3 types of things which the institute can do. So let me ask you all a question. Assume a sample of 100 FRRB reports. How many do you think the institute, our own institute, could have referred back to the regulators as a percentage? Make a broad guess. 10%? Okay, he says 10%. 100, sir. No, sir. Sorry? Oh my God, that's a good one. Out of 105 reviews, 18 were referred to the Director of Discipline to take action against the firm or the chartered accountant. 16 were referred to the regulators. And 53 advisories were issued to the auditors.
How they choose the 105?
That's a random. They go by a random thing. Public. No private. There are few privates also they take, but most of it is public only. Private is only on information given by SEBI or, by MCA. To me, 34 out of 105 is an alarming figure. It's a very alarming figure, which means that 34 audits, the institute has found it problematical to refer either to regulator or to the Director of Discipline. Of course, advisory issued to auditor is okay. We will not worry too much about it. And this is, FRRB was set up in 2002. 22 years in existence now. But they've also had their own challenges in terms of number of companies they can select, how many companies they can do, number of people who will join the committee, all these things is always there. Only recently they made the entire process online also. So which comes to a very basic question. Why do errors occur? Why do errors occur? I'm not talking about the financial statements. Let us restrict our discussion only to from the auditor side. Now we know that out of 105, 34 there have been errors of whatever nature, doesn't matter what it is. Why do these errors occur? There we don't have the resources. Very good. Shortage of time. Okay. Resources. Very good. Combine the two.
Compulsion by the company.
Oh.
Within 14 hours, within 24 hours.
14 hours I po, not days. Huh?
Days.
I thought it's become days. Combine what he said, lack of resources or lack of qualified resources, with what he said about pressure of time. What do you get? You get a challenge wherein you are, if it's a listed company, you have to issue the LRR in 45 days time. Oh, you have this challenge now. 45 days time is there, and you've got the resource constraint. As he said, now this 2-year articleship, I do not know what has happened, but positive, huh? Okay. Positive means you're getting number of better people, huh? Better people or better people, okay. Costly, huh? Worse people, okay. He says worse people. In fact, our experience has not been so good, but maybe Vikram has got a better experience because I think they offer more stipend, I think that's why. I think that also. Yeah, exam badi parvail, that's okay.
Previously we used to give 5 months exam leave.
Okay, that's
No exam leave.
correct.
To complete 2 years, they are available. And go, it's a pretty.
Okay, good. I'm happy to learn that, but unfortunately, we found articles to find exam leave, they'll find some other type of leave, But anyway, that's very good. Talking to the girlfriends, very good. Even more value addition. In our office, even audit managers are looking at their phone and talking to girlfriends. Forget about the partners. Okay. But we have a problem here. It's a serious problem because what happens is that in your 45 days time, when you got a lack of adequate resources, you are signing a limited review report which everybody is seeing. You are signing an LRR which everybody is going to see. They don't know about the background of the company. They don't know the financials of the company. You cannot afford to make a single mistake in the LRR also. Forget about EOM, forget about key audit matter and all those things. Various problems crop up. I still remember this, our office, first listed company audit, same 45 days time. The client was based in Hosur, and excitement of the partner was go to Hosur, 45 days means 45th day. He was signing the audit report on the 45th day, and he called me up at 4:30 and said, "Sir, audit report is done. I'm signed it. I'll send it to you. Just have a look." I said, "Okay, fine, very good." So he sent it to me at 4:45. I had a look. I said, "Everything is perfect. Only thing you said is you've written Bangalore in the audit report, but you're in Hosur. So please change it to Hosur." He's already halfway to Bangalore. He assumed that it is not a mistake. You ask Vikram, the number of FRRB comments which have come saying that place of signing of the audit report, you have not signed the correct place. How did you sign? We had a peer review in which the peer reviewer asked me, "I've signed an audit report." He said, "Sir, how can you sign in you sign in Bangalore and the client is in Hyderabad on the same day?" I don't know, Hyderabad only 1 hour flight, no. Not very difficult from Bangalore. But why I'm telling you all this is because people are looking at all of these things, asking these questions. On one hand, we have that problem. On the other hand, we've got to see what we can do in terms of, so definitely too many things to do, too little time to do it. It's a definite problem. We've got so many things to do, there's too little time to do it. And now if you add the burden of NAFRA, that's even a bigger challenge there. Lack of guidance on complicated items. Institute is coming out, but every single transaction becomes a little bit more complex. And as I said, the institute has got a publication for every possible area. They have also brought out this brilliant publication on commonly found errors in reporting practices. Now the purpose of this commonly found errors is that? Fantastic, sir. Very good. But the problem is the 4th edition, which means that not the old errors, new types of errors. The errors are not stopping. The errors are not stopping there. Now, the problem here is also going to be, they've given you including industry-specific observations. Industry-specific observations in this document. For example, what the RBI is saying, what IRDA is saying, and what has not been followed, all of it, to a large extent, has been there in that particular report there. I will not speak too much about NAFRA because everybody has got their own views on NAFRA. But in my mind, at least to my mind, I think the main part of the NAFRA's job, which is trying to improve audit quality, finding fault has gone away now, I think. I think now they are on a mission to, that's why Venkata was talking about ECL model. They are trying to bring out publications. So whatever has happened, has happened. Let's forget about it. Whether it is CCD, ILFS, Divan Housing. See, out of 76 orders of NAFRA, 49 are only for CCD and Divan Housing. Out of 76 orders, 49 orders are only for two companies, CCD and Divan Housing. ILFS, another 3 or 4. In fact, I'll just add on to what Vikram was saying about these things. See, the very interesting thing about these errors and how do you sort of look at these errors. He mentioned about clause 21 in CARO. Have you seen any qualifications in the subsidiary companies' audit reports? Why did that come? I'll tell you why it came. You look at the ILFS is not a listed company, so you may not have private to that information. ILFS had about 200 odd subsidiary companies. Most of them are only investment companies for the purpose of giving loans and taking back loans. They didn't have any active.
In the time of 45 days or 3 months, how they will compare and refer that 400 subsidiary companies?
Sir, 400, sir, 200, sir.
200 subsidiary. It's certainly not possible.
Not possible. But okay, transactions were less anyway. Later on, when Uday Kotak sort of took over this ILFS thing and he gave some sort of information, it was observed that out of 249 subsidiary companies or 230 subsidiary companies, 70% of the losses of ILFS came only from 4 subsidiary companies. 70% of the losses came only from 4 or 5 subsidiary companies. One of those subsidiaries was a company called Gujarat Pipa Port. Other one was in Nasik, one project, road project in Tirupur, and one project in West Bengal. These 4 projects contributed 70% of the losses of ILFS. Very interesting situation. I had the opportunity to look at the audit report of Gujarat Pipa Port. I am talking about 2014-2015 audit report. Gujarat means what should be the name of the chartered accountant?
Patel or something.
Ah, very good. Patel or Patel. No, I am talking about subsidiary company auditor. I am talking about the Gujarat Pipa Port. Adana theriyad, sir. Related parties சொல்றீங்களா? Possible. Gujarat Pipa Port 2014-15 audit report. Going concern was qualified by the auditor. Small audit firm in Ahmedabad, subsidiary of ILFS, qualified it as a not being a going concern because of whatever losses and all those things. The statutory auditors consolidated the financial statements. They should also consolidate the audit report, which they did not do. Which is why this clause has come in CARO, saying that have you considered any qualifications, any observations made by the subsidiary company auditors in the financials? If you've got to do that, you add this also. I mean, we obviously learn by experience, but the fact remains that if you ask a question, why was it not qualified in ILFS, the answer will probably be was immaterial. Considering the size of ILFS, it was immaterial. But the problem still happens that if you are looking at the subsidiary company auditor's report, and now of course after all this SA 600 and all these things come in there, we've got even more issues there. you will also have to take into consideration what will be the impact on the holding company financial statements. A very clear thing which happened in the ILFS situation. Okay, anyway. So, when we look at this, so I was talking about NAFRA. They will now go into a education mode. ILFS is over, Divan Housing is over, Cafe Coffee Day is over. Every one of these companies auditors have filed appeals in NCLT. Byju's is pending. Byju's Institute is not. Institute also looking at it. The Institute FRRB also is looking at it apparently. The auditors have filed appeals against his orders in NCLT. We expect the NCLT orders to come in favor of NAFRA only, because there's a Supreme Court judgment also which has come in favor of NAFRA. But I mean, that all that aside. So now what will happen? We will get into a education mode. In fact, I should tell this to you all. We had a program. I keep doing programs for NAFRA also, and I did one recently in which the chairman had come in Udupi for this body called as IACA. One of the things he has told this IAC team is that you develop an online training course for auditing standards. Imagine NFRA doing an online training course for auditing standards, accounting standards. It will probably include all of this information. If NFRA is doing it, everybody is doing it, it's always going to be a question, what will we do? What will the institute do? So there's a problem there, there's an obvious problem there. But they are very clearly, if you look at what Venkata was saying about the ECL model they've given also, they are now getting into a mode of training, education. Those reports, some of those reports will be there. Some of the reports will be there. As Sir was saying, if it is a fault-finding mission, it is a fault-finding mission. There is no end. If I give him my audit file today, if I give it to Vikram and tell him that please find a mistake, he'll find 25 mistakes. He will find a lot of mistakes. Obviously, any one of you will find mistakes there. But I think the intention of NAFRA seems to have been generally that sensitize the people that there's a problem in audit quality, improve the audit quality. If you ask me, today as we are speaking, that mission seems to have been achieved. People seem to be sensitized about audit quality, to a certain extent at least. And now that's why probably those so many orders against chartered accountants, fines of 5 crores, 3 crores. In my opinion, there will be a few, they will be lesser in nature. They will not be as frequently as what you've seen in the past, because when auditors have been sensitized, obviously it will come, as he was saying, there will be some space in the audit report. Auditors will mention this in the audit report. In case they mention the audit report, they will have a problem. See, NAFRA, I should tell you, was, as I said, I'll just give you an example for this. There's a company, there's a body called as Public Company Accounting Oversight Board in the US, which was established after Enron happened. We should always be thankful to Enron for a lot of things. Whistleblower policy, Enron. Rotation of auditors, Enron. NFRA to a certain extent, Enron, because PCOB in the US was, NFRA is modeled on PCAB. The auditor is not involved in that. So, it's only a question of provisioning for how much of damages compensation to pay. So, Public Company Accounting Oversight Board, first they said all US listed companies. Okay, no problem. None of us in India were worried about it. Only the auditors of Infosys, Rediff and all were worried about it. Then they said that, no. Auditor of a US holding company listed in India. Subsidiary of a US holding company in India or any other geography. They also will have to be registered with the PCOB. There are 1,000 companies in India who are listed, who are Indian subsidiary companies, listed companies in Pfizer, even smaller companies. All of these companies, all the auditors of these companies filled up that form, got registered with PCOB in the US. PCOB in the US has got the power to come and inspect your audit files. They can come to your office, ask you for audit file, and tell you that these are all the things which you have to improve in your audit or whatever they want to do. Audit firm in Pune. Client is fintech company, listed company abroad, subsidiary company in Pune. 2018-2019, full financial year, 4 transactions of sale, 2 transactions of purchases, 12 months salaries. These are the financials. 4 transactions of sales, 2 transactions of purchases, 12 months of salaries, single bank account, not multiple bank accounts. Auditor did his job, he gave the report, whatever he did, Indian Companies Act, all that he gave. PCAOB came for inspection. Because they came because US company was listed for. They came to the Pune firm and said, please give me your audit file. Auditor said, okay, audit file. Yeah. No, what a big audit file. Yeah. 4 transactions of sales. I've got 4 original copies of all the invoices. 2 transactions of purchases, no problem. 12 months salary statement, no problem. I'll give you payroll register. Bank account, multiple copies, you take same bank balance, no change. He gave one audit file and told him that this is my audit file. But what is the job of the PCAOB? Find mistakes. The first question he asked the auditor was, what is your audit? Where is your audit plan? Auditor is saying, audit plan for this company. Okay, audit plan is there. What is audit plan? 100% vouching. 100% confirmation of balance. 100% verification of bank account. This is my audit plan. Like off balance sheet things also. Correct. Anyway, so he said this. So he said, where's the audit plan? The partner said, okay, this is my audit. He said, no, please document your audit plan. So this man said, okay, fine. Even this I have to do, fine, no problem. What are the audit fees? 25,000 rupees. 25,000 audit fees. He said, okay, fine, I'll do this also. PCAOB is asking me how to do. Next question. What are the major risks you visualize in the audit? They say 240. Risk. Then this man said, I don't see any specific risk. Only risk is audit fees may not be paid. He said, no. You are not identified. We'll go back to that point which you also said, no, about there could be something outside the balance sheet also. He said, no. You're not documenting your risk properly. So he gave he was about to give a comment saying that your documentation is not as per the required PCAOB standards. This was a comment he wanted to give. But thankfully the partner, he sort of told him that we understand that you're coming for this thing on a larger scale, but we'll agree to improve our practices. Can you just give us a letter of recommendation saying that this is what you have to improve? Don't give a negative report. So they gave a letter of what you can say, recommendation and went away. But this is happening. With the PCAOB, yeah. Only then they can come, otherwise they can't come. They can't come otherwise. That is why I keep telling that, like all of us have been discussing, always better to have Indian chartered accountants to tackle regulators. I'll tell you why. The same PCAOB in 2012-2013 itself, US audit company, US audit firm, they were inspecting their audit files. One thing which Satyam has taught us, whenever there's a bank balance, confirmation letter, that 2, 3 originals, 4 copies. Don't change that. So this audit firm had this problem. PCAOB people inspected it and said that, okay, Citibank balance confirmed. Yes, sir, confirmed. Where is the balance confirmation? There, sir. What is the job of PCAOB? Very good. They said, okay, all this is fine. You got the confirmation of balance, I completely agree, but where is the covering letter you sent to the bank? Asking for confirmation of balance. Physical. Where is the covering letter you sent to the bank saying that you have asked for this thing, bank confirmation? The audit firm said, I don't know where it is and all those things. He was a bit, he said, I'll get back to you whatever it is. This happened 2012-13. The audit for the year ended 2010, 2 years prior to this. The partner of the audit firm was obviously very worried. He said PCOB may give a negative comment. All the PCOB reports are in public domain. He was very worried, saying that they'll give a negative comment. There was one Indian chartered accountant there. He said, sir, why are you so worried? He asked the partner. He said, no, your PCOB has come and they've asked for this covering letter. So we have a problem now. They may give a negative comment. Covering letter, no. Which date you want, he asked. Which date you want? So the partner was surprised. He said, you want covering letter? No, I'll give it to you. Don't worry. He said, no, but they should not be like, they should not. He said, don't worry, they will not get any suspicion at all. You just tell me which date you want. Date was decided upon. He typed out the covering letter. Luckily, bank was existing at that time also. He went to the post office, got a seal on the covering letter, came back, put some little bit of sand or mud on that covering letter to make it look as though colorful letter, 2009. And kept it in the file and told the partner that covering letter is here. Partner immediately said, shall I call PCOB? No, don't call them immediately. Indian chartered accountant, no, let them wait. Last date will come, then we'll tell them. Don't tell them in advance. 31st December means we'll tell them when. 31st December only. Last date was approaching, partner called up and said that, sir, thankfully we have found the letter. Can you please come to the office? He found the letter and said, where was this letter till now? He said, sir, very great difficulty we found it. It was in some other audit. With great difficulty it was in some other audit file. So finally we got it. But we completely agree with you. We will have to.
But that letter copy has been sent to the.
Illa sir, they didn't get that. I don't know all that what happened. Those investigative questions you should not ask. No, but I'll tell you why. It's actually happened.
Had he verified with that bank?
No. I'll tell you what you're saying. I'll tell you this also. I'll give an example. Don't worry about that. So there's a company called Chinese company in US called as Toys R Us. TOYSRUS. China company have got a very good habit. Bad habit actually. They will not list in China. They list in US only. Because the investors we can tell whatever and get away with it. China, this Toys R Us had a bank account in Citibank only again. No, I think it was Chase Manhattan, not Citibank. I told you, this again happened 2010. What Satyam has taught us is confirmation of balance. Big four audit firm auditors of Toys R Us. They had multiple bank accounts. One bank account was in Citibank. Partner called up the CFO and said that, hey, listen, I'm going to Chicago tomorrow morning for some other company work. Normally, I used to get the confirmation of balance by mail. But please tell me the name of the manager. I'll go and meet him and get the confirmation of balance in person. He told the CFO this. It's in public domain, this also. CFO said, okay, I'll give it to you. Never gave it to him. This man also said, okay, maybe he's busy or maybe he'll tell me tomorrow morning or whatever it is. So 11:30 he was scheduled to go to the bank. 8:45 NASDAQ opens in the US. 8:46 announcement, auditors have been changed. They've removed the auditors from the same company. This partner was aghast. He's calling the company CFO what we invented and gave, missed calls. Missed calls were invented in India only. Why do you give a missed? Why we miss calls? You don't want to give the answer. Missed call, not taking the phone. This man knew something was wrong. He said, okay, doesn't matter what it is, I'll go to the bank. Doesn't matter what it is. I don't care if I'm not the auditor, I'll go to the bank any which ways. So he went to the bank and told the manager that I was the auditor of this company till 8:45 in the morning today. Now I'm no longer the auditor. I've come for a very specific purpose. I understand that I've been removed as the auditor, but I still want to know whether the confirmation of balance is there on that day because I still have to sign that previous year's audit report. I want to know if it is there or not. Manager said, okay, fine, give me 5 minutes. I'll find out what is the thing and all. And he came back and said that, sir, I'll definitely give you the confirmation of balance on one condition. If an account is there, I can give you confirmation of balance. If there is no account, what confirmation of balance can I give? Because of some, internal problems, or I won't say, I should probably use the word called fraud only, between the company and the bank, this bank statement, this bank account was not existing at all. Now, obviously, this person, he has been removed as the auditor now, but he has still not signed the previous year's audit report. It became a challenge for Toys R Us to actually appoint a new auditor. Because all the new auditors said that until you tell us what has happened, we are not going to accept the assignment as auditor. The PCO came into the picture and said that until you give a full disclosure as to who was responsible, what has happened to this fraud, we are not going to allow this firm to be audited also. Of course, they are subsequently, I think after 2 or 3 years, they applied for bankruptcy. But again, I'm giving this example just to tell you what is the requirement there. Okay. I'm just going to go to a few things which Vikram spoke a little bit about related party disclosures. I will also add on to this. Please remember a couple of things. Related party transactions are not banned. Nobody is saying related party transactions are bad or should be banned, should not be done. It should be disclosed, arm's length transaction, as I said. Again, we know this very well. Look at whatever NFRA has been reporting. Look at all the auditing scams, all the accounting problems that have happened in the country. Every single one of them can be traced to a related party transaction. Satyam Mehta's, ILF subsidiary companies, CCT subsidiary companies, Divan Housing, also subsidiary companies, every one of them. The advantage as well as the biggest weakness of related party transactions is their sheer convenience. It's just very convenient to do a related party transaction. The convenience of related party transactions becomes both an advantage as well as a disadvantage. Audit committees today, for example, give omnibus approval. To me, it's a very dangerous thing. You should probably try to get transaction by transaction, or at least a set of transactions. You give an omnibus approval for 25 crores for related party transactions. Within that 25 crores, many things can happen. So there is a situation wherein probably it is not enough to only disclose related party transaction. Identification also is important. More importantly, somebody at the audit committee level or the board level should probably also say that these transactions are fine. These have been seen by us, maybe internal auditor, I do not know. But I'm just saying, trying to give a solution, saying that this has to go to one more level of detailing here. Can the auditor's remuneration in both standalone and consolidated financial statements be the same? One observation from FRRB. Consolidation audit report says audit fee 75 lakhs. Standalone 75 lakhs. Same auditor. Which basically means that CFS or SFS, I do not know what he has not taken it for. But, sorry? It's inclusive of both. But again, the reason why I'm telling you this is because of two things. One is that risk is always there, that we are not saying, but the fact that this has not been disclosed or come separately, or the figures are not broken up separately, appeared to be giving the impression that you have not charged audit fees for one particular entity. It could be standalone, could be console also. But then, I think this is a more, what you can possibly, see, because we know, we all of us know this. It happens with our clients. There's nothing wrong in this practice. Wherein the company will say that, sir, I've got 10 subsidiary companies, sir. Only one company main transactions are there. All the remaining 9 are, I'll tell you why they are. But there are 10 subsidiary companies. Don't charge audit fees for every one of these companies. You charge if you want, but I'll give you one consolidated audit fee, whatever the number is. How you break it up among these companies is your problem. So in those situations, we have this problem. It appears to me that we may want to probably break down the audit fees and show that audit fees separately as this thing here. Okay. Oh, I missed that. Is it okay? Deferred tax liability consists of deferred tax on fixed assets and provision of gratuity. Just a disclosure given, table not given. The reconciliation was not given. This is a comment which was given there. Okay. I think one of the things which I'll probably suggest to all of you all, and I keep doing this in most of the places where I go to, there are 46 auditing standards which have been issued by the ICA. As I said, you name the transaction, you have an auditing standard. Sampling, there's a standard. You want confirmation of balances, you want opening balances, there's a standard. The problem is always going to be how many of these would apply to an audit which I am doing today. Let us say a small private limited company in Chennai, you are doing the auditor, you are the statutory auditor. You may not have, out of these 46 standards, maybe about 20 may apply. A ballpark figures, maybe 20 may apply. The remaining 26 will not apply. But please say why they do not apply also in your documentation. But if you look at how things have happened generally, and if you ask me, one standard wherein a lot of, I will say probably improvement, for the lack of a better term, can be done is in SA 230 on documentation. Documentation, I'm very clear that the quality of the documentation we do is going to be very, very important. The documentation, they say, should speak for itself. I'm going to give all of you all a small task to do. If possible, you'll see if you all can do this. Go back to a 31st March 24 audit, which you have already done. Can be any audit. It can be a tax audit, can be a statutory audit, can be anything. Take the audit file. Take the audit file and make one small document. What are the major observations you have observed in that audit and what were the conclusions? What are the major observations? It can be a half-page document, one-page document. Doesn't matter how many pages it is. Length doesn't matter, quality matters here. Make one small observation sheet or what you can call as conclusion sheet which says that these are the observations which you have made in the audit and this is how we have concluded. I will venture to say that it may not be there in your audit file. I'll venture to say if it is there, well and good, no problem at all. If it is not there, don't worry about it. Try to make it at least for 31st March 24 so that it becomes a reference point for 31st March 25. A lot of, see, today we are in a situation wherein we have to actually defend our audit. We don't know when we have to defend our audit. Anybody can come and ask us now. The only way we can defend our audit is by having a documentation which says that these are the observations made, this is how we have disposed of. Don't worry about judgment and all those things. Why it was not EOM, why is it not qualification, don't worry about all those things. You try doing this simple exercise and I think for starting what will happen is that you will observe that ultimately who does the audit? The article clerks. It has to trickle down to their level. They have got to be doing this. This document has to be done by them. Maybe they have observed a few things and told you all, but use it as a reference point and do the same for 31st March 2025 because that will become your savior for the audit. In our office also we had a peer review. Normally peer review means we do 1 month of preparation. Most of the documents will not be there. So lot of preparation, lot of running around, calling client, we could on the document, could give this, give that and all. We did a lot of things. We sort of basically knew which companies is going to take up for peer review. We sort of knew, okay, 2 listed companies, 1 large company, 1 insurance company, 1 bank, whatever it is. But we forgot one thing. He took 1 company which was not on our list, or at least we were not prepared for it. Small private limited company, which is again based in Bangalore, and one of my partners is signing it. No problems at all, but anyway, we thought that he said, I'm going to take this up also. I said, okay, fine, please take it up. Whatever documentation you want, we'll give you, no problem at all. He came at 5:45 evening to my cabin and said that, Mohan sir, one small request. Tell me. Yeah, I've seen your audit file for this company. Yes, sir. I want trial balance. I said, well, you don't have trial balance. No, he said there are trial balances. There are 9 trial balances. I want one final trial balance. I don't know which is the final trial balance. I said, how is it possible? It should be there. No? She said, no, it's not there. Just find out. So I called the audit clerk and asked her, what happened? She said, I also don't know, sir, she said. Her solution was very simple. Sir, I'll call the client and ask him to give final trial balance. I said, good suggestion, good idea, but please be a bit careful. That may be the 10th trial balance. Before you get it also, please check once whether these pass these entries, whether it's actually matching with your financials or not. At least ask that question. She said, okay, sir, no problem. I'll definitely ask. So she went and asked the client. First question the client asked was, you don't have it, we don't have it, obviously. That's why we're asking you, no? So a little bit of back and forth happened between client and her. Ultimately, 8 o'clock, she sent me a message saying that final trial balance received, net profit not matching. That's it. Net profit not matching. And tomorrow morning, the peer review was supposed to conclude his peer review and said that, okay, this is the files you have seen, whatever it is. So, of course, we got into a lot of discussion with the client and told him why is this not there. Ultimately, something happened. We gave him something happened. I'm still not convinced we gave the actual trial balance. But anyway, it's over. The reason why I give this example is because when he told me that, please give me one final trial balance. I don't want 8 trial balances. You can have one trial balance at the beginning of the audit and one at the end of the audit. Don't tell me what and all happened in the audit. That's not my job. That's not a part of my peer review process at all. So that documentation also becomes very important. So my suggestion will be that if you all do this small memorandum sheet, please remember it can be nil also. It can be no observations. It doesn't matter. Develop the practice of doing this memorandum sheet because it gives you all an idea that these are the major observations. Then it will lead on to what are the risks in the audit and all those things, and then you can reach the necessary conclusions also. Okay. Ind AS, lot of things have already been said, but I'll just give a couple of points. I've called it as the OCI temptation. Venkata was speaking a little bit about FET OCI today, and many a time, the Ind AS, what happens is that when you pass journal entries, debit side everybody will say perfectly. Purchase of or fair value of financial instruments. Debit, P&L accounts, sir. No doubt they will say. Credit side, if you ask them, they will say balance sheet, sometimes P&L account. If they are completely clueless, sir, OCI is there, we'll put it in OCI. Any other OCI is there. We'll put it in OCI. It's a temptation. It's a temptation to put this in OCI. Please remember that OCI is not a parking ground. What can go into OCI, what can come out of OCI is very specifically mentioned in Ind AS 1 itself. You cannot just put it there for, let it be there for 1 year, then we'll see what is to be done. It doesn't work that way. It has to be very specific. Many of these things have happened there. Just a few other, I'm just talking about, look at this now. This is a very interesting thing here. Toll gate. All of you must have passed through toll gates. All of you must have been reading that equipment. Sometimes it works, sometimes it doesn't work. Most of the times when I am the toll gate, the car in front of me will be blacklisted. I don't know why. Maybe it is my car's mistake, I think. Possible. Very interesting discussion about this toll gate, that reader machine which comes, which stops that. Is it property, plant and equipment? Is it intangible asset? Or is it a combination of both? Or is it investment property? Because they charge a rental on that also. The entire thing actually works on software. The entire thing actually works on a software. It's like that barrier which comes is only one part of the entire process. The reader works on software. Capturing your car's registration number works on software. So many companies have taken the stance saying that major portion of this is intangible in nature, therefore I showed as intangible asset. One small portion is their barrier, I'll include it in my intangible asset. If you want me to segregate it separately, I'll do it separately also. But how much do you actually try to put for that barrier also became a problem. So many companies have shown it as intangible assets there. See, as Vikram and Venkat sir also saying, and also answer a question somebody asked in the morning about matching concept. At least in AS, you had 29 ASs, options were slightly limited. In Ind AS, you've got 39 Ind ASs with plenty of options. So there's a complete sea change in the way in which these accounting standards also work. The idea behind the disclosure is that, okay, you've chosen an option, disclose it. You've chosen to put this in intangible assets, no problem, put it. It may be right, but disclose it properly. The idea behind the disclosure appears to be that, as the disclosure will sort of take care of this thing here. Okay. There are a lot of, as I said, you look at, Vikram was mentioning also about key audit matters. There are 5 minutes and more, sir. Key audit matters, major risks noticed in the audit, and how the auditor has evaluated those risks in his audit. You look at any large company, look at Infosys also has got revenue recognition as key audit matter. Revenue recognition in Infosys has become a key audit matter. Again, I'm not saying it is wrong, but what it tells you is that there are so many assumptions and judgments which go into that revenue recognition that auditor has been forced to put it as a key audit matter. When the assumptions are more, what is the risk? Probability of errors obviously also increase. When the assumptions are general in nature, when they give you too many options, there is a possibility that we can use those assumptions or those judgments for the purposes of trying to, what happened here? Oops, I don't know what I've done, but yeah. Okay. Definition of control. This itself is a conceptual problem in Ind AS. Power to change the variable returns from the investee is a definition. What does it mean? Nobody knows. But in effect, what it says is that I may have a 20% shareholding, may not have control. I will not consolidate. Sorry, I will have control, I will consolidate. I may have a 80% shareholding. I may not have control. I will not consolidate. This judgment can change year to year. I should not be saying this, but this is an option which is exactly what happened in Enron. Enron wanted to consolidate, they consolidated. But they did not want, they did not consolidate. But as I said, these standards have been principle based with a reason. The idea is that the principle you chose, the principle you interpret, you apply it consistently, number one. Second is, please disclose the principle very, very clearly. I already spoke to you about disclosures, and I think Vikram has also spoken to you about a lot of things on the CARO, so I really won't get into that. But on the main audit report, in the main audit report, I would still say that look at the SA 700 series of auditing standards. We have come to a situation today wherein, as I said, the risk-reward ratio is more towards the risk. If there is anything you want to say on the audit, please mention the audit report. I understand that it's very easy for me to say this, but I would only suggest that please judge this risk-reward ratio. If the risk is very, very high, you may want to think of putting this in the audit report and trying to sensitize the client that I have no option but to put this in the audit report. He may try to say that, there's something called rotation of auditors. It doesn't matter. I think we have come to a stage today wherein we feel that if the risk is very large, the reward is not commensurate, there is no point in doing the audit. There is no point in doing the audit. Of course, it depends completely on audit to audit basis. It depends on client to client basis. I cannot give you a formula for this. However, I will leave you all with this thought saying that we should also remember this very clearly, that as long as the audit fees is being paid by the client, please remember this, as long as we are dependent on the client for the audit fees, the question of 100% independence may not be there. We will have to do a little bit of give and take, because audit fees, we are dependent on it. It can be a significant portion. It is important for us. It may lead to other clients also. But there is always what is called as the Lakshman Rekha. If that Lakshman Rekha has been crossed in whatever way it is, it could be very aggressive accounting, it could be not listening to you, all these things. Please ensure that the client is sensitized. And because, I mean, again, I'm not telling this again from a regulatory perspective or SEBI or NAFRA and all. It is for our own good that we don't do such, or we don't sign such audit reports only because the risk is very, very high. Tomorrow we don't know. See, today in the world, what is happening is everything is traveling very fast. News travels very fast. One bad report on audit firm in Chennai, I'll get to know about it in half an hour because of WhatsApp. Maybe true, may not be true, but I'll get to know about it. So when the news is traveling so fast, we also have to be a little bit ultra careful in what we do for this particular thing there. Okay, and how do we avoid errors? Last point, can we avoid errors or minimize them? We cannot avoid errors, we can only minimize them. I'll leave you all with this thought, saying that 100% error-free audit. Very good, sir. I didn't say it, he said it. What we can do is minimize the errors, and more importantly, don't repeat the same error. Don't repeat the same error as per last year. And self-review of the financials by the management. Tell those people that tomorrow's audit committee, don't give me financials today. You give it to me, I have no problem. But can you just look at what is your profit? Can you do one small review of the financials yourself? Invariably, we find that because of this pressure of time, they also give these financials at the last minute. There's no review done by them themselves. So they themselves are not very clear about the figures which they are talking about. So ask them to do this one day in advance. Let them make a review. Give them a checklist. Ask them, have you seen all these things? Let them sign off on the checklist. And finally, after that, give you all the financial statements. And the last point is documentation. I've already spoken to you about. Please do this memo note. Document to the extent possible. For all the audits that I've done, please do it. And I'm quite sure that going forward, these sort of errors will not be there, and we'll probably be able to get to a situation wherein very little mistakes are pointed out in our audits. Thank you very much for a patient hearing. Thank you very much.
Thank you, CA Mohan ji, for the interesting session. Okay, with lot of live examples, and in fact, your experience in peer review, it was really interesting. Thanks for your both the sessions today, and I'd like to thank all the panels. I think it was quite useful for most of us. Thank you, and with this we conclude. Thank you.